You can leave.
This is embarrassing.
Sorry.
Never mind. This is what is about to happen. Is that for me?
No, I'll get you one.
Yeah. Chairman, how are you?
Just wanted to say hi.
Good to see you.
Thank you, sir.
But I always feel so
The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. The hearing today is entitled Oversight of Prudential Regulators. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. Just one additional comment for members about the schedule. This hearing has a hard stop at 2 p.m. in an accommodation of the 3 regulators before us, so it will not go past 2 p.m. And so now I'll recognize myself for 4 minutes to give an opening statement. We're here to conduct oversight of our prudential regulators. There's plenty to discuss. Each of you on this panel has put forward a proposal that require robust debate and explanation, yes. But you're first up, Mr. Grunberg, and we all know why. You've failed your employees, your agency, and the American people. The fact that you've not yet resigned proves that you take no responsibility for your actions, and the words that you've used so far also make it clear you take no responsibility for your actions. And let me be clear, showing up today is not an act of courage, it's an act of hubris. Last week, we were confronted with a report outlining appalling and abhorrent behavior at the Federal Deposit Insurance Corporation. This includes Mr. Chairman, your verbally abusive behavior. This is beyond partisanship. It is clear from this report that deep institutional changes at the FDIC are necessary. Mr. Grunberg, you are not the right person to lead those changes. President Biden once said, and I quote, "I'm not joking when I say this. If you're ever working with me and I hear you treat another colleague with disrespect, talk down to someone, I promise I will fire you on the spot." So I ask my colleagues, Democrat and Republican, the president as well, if that behavior outlined in this report doesn't rise to that level, what does? Unfortunately, some of my colleagues may attempt to defend the indefensible today by shifting blame to Republican FDIC chairs. But let me remind my colleagues, Chair Grunberg has led this agency for 10 of the last 13 years. You may hear about employee favorability ratings, which come from annual surveys conducted of federal employees at federal agencies. There was a decline in satisfaction in the 2018 survey, which only included a couple of months of former Chair McWilliams' tenure. So that steep decline was dissatisfaction with Chair Grunberg. Then in 2020, during the core of former Chair McWilliams' leadership, FDIC employee satisfaction went up to its highest level since 2012. And that was before Mr. Grunberg's first stint as chair. When Chair Grunberg returned to lead the agency again, employee satisfaction plummeted. So I employ my colleagues to be consistent when judging the behavior of our regulators. This isn't just about mismanagement, it's clear misconduct. It's a shame we have to spend this much time talking about your conduct and failed leadership. There are very real issues facing our financial system that deserve this committee's full attention. The Biden administration's banking regulators are busy pursuing serious agendas, some of us view as partisan agendas, that are focused on policies that don't support the economy, the financial system, and the safety and soundness of the financial system, or the needs of American families. But first, we have to focus on the conduct of the FDIC chair and ensure that this very important agency returns to a safe and sound manner and practice as our financial system needs it. So, we have significant proposals at the FDIC, yes, and at the Fed. And just earlier this week, Chair Powell testified that the Basel III endgame proposal would undergo significant changes, and I view that as quite promising. And I hope my colleagues will ask Mr. Barr about that as well. And so with that, I'll yield back and recognize the ranking member for 4 minutes for an opening statement.
Thank you very much, Mr. Chairman. Good morning. I'd like to thank our witnesses from the Federal Reserve, the FDIC, and the OCC for coming before the committee today. I want to start by addressing the FDIC report on workplace culture and sexual harassment that was released last week. The report was deeply troubling and makes clear that under both Republican and Democratic chairs, the FDIC has not done its job properly. Its job to properly address the deep-rooted toxic work culture that has festered over many years at the agency. All employees deserve a work environment where they feel safe, and it is Chair Gruenberg's responsibility to make sweeping changes promptly for the benefit of every FDIC worker. While the report scrutinizes Chair Gruenberg, I'm disappointed the report seemed to downplay workplace concerns and complaints of harassment that occurred under prior Republican agency leadership. Regardless, the FDIC as an institution has a lot of work to do. The agency can start by expediting the implementation of the action plan I requested of Chair Gruenberg last year, along with the recommendations laid out in the most recent report. As the report states, tone does start at the top, and I'm concerned that Republicans who have been quick to call Chair Gruenberg to resign are selectively applying that standard. After all, the top Republican and nominee to be president is currently on trial regarding the first of a series of criminal indictments and has been found liable for sexual abuse. Hopefully, this concerns them too, and they will call on the former president to step down and withdraw his nomination now. I look forward to hearing from Chair Gruenberg, who has committed to making the necessary changes to turn the tide on the culture at the FDIC. Under the leadership of Chair Gruenberg, the FDIC has done a lot of important work, including its work to combat modern-day redlining by strengthening the Community Reinvestment Act, not to mention the quick action taken to prevent last year's regional bank failures from spiraling into a full-on financial crisis. As important as this work is, it will be permanently tainted if the working environment of the people doing the work remains mired in toxicity. It is crucial that we have a regulator who works every day to not only promote stability and ensures the banking system serves all of our constituents, but also treats its employees with fairness and kindness. I'm disappointed in your performance on the latter, Chair Gruenberg. Turning to a few other matters that are the subject of today's hearing, I want to applaud the FDIC, OCC, and FHFA for heeding the calls I made after last year's bank failures to implement Section 956 of Dodd-Frank to hold greedy bank executives accountable for reckless risk-taking. It's past time for the Fed and other regulators to follow suit and implement this congressional mandate without further delay. In addition, I look forward to hearing what our regulators are doing to build on Committee Democrats' record of protecting consumers. In light of the proposed Capital One and Discover merger to create the largest credit card lender in the country, I want to hear what regulators are doing to put away the rubber stamp and strengthen bank merger reviews. I'm glad the Fed and OCC announced they will hold a public hearing in July. I hope regulators listen to the feedback and then block this deeply flawed merger. As the climate crisis worsens, I'm also eager to hear about their efforts to ensure climate risk is taken seriously as a risk to our banking system, and that diversity and inclusion is front and center, especially in the light of misguided Republican attacks. I look forward to today's discussion, and I yield back.
We'll now recognize the Chair of the Financial Institutions and Monetary Policy Subcommittee, Mr. Barr, for 1 minute.
Mr. Gruenberg, the Cleary report on harassment issues at the FDIC outlining your temperament and inability to lead shows an agency in crisis. As the report made clear, your stubborn lack of self-awareness and mismanagement mean that you are not the person to respond to the FDIC's crisis, and you do not have the moral authority to lead the needed transformation of the FDIC. The Cleary report and your prior participation in Operation Choke Point and the leadership coup at the FDIC that you engaged in with Mr. Chopra makes clear that you prioritize politicizing a supposed independent agency over the safety and soundness of our financial system, and therefore it's time for you to resign. Do you think for 1 minute that if the kind of misconduct outlined in the report was uncovered at an FDIC-regulated bank, that Chair Gruenberg would offer any kind of grace to the management of that bank? The question answers itself. On the issue of Basel III, I want to make my ongoing position clear that the fundamentally flawed proposal must be scrapped, and at most, there should be a reproposal if justifiable. I yield back.
Now, the ranking member of the Financial Institutions and Monetary Policy Committee will be recognized for 1 minute. Mr. Foster.
Thank you, Mr. Chairman. Last week, like many of my colleagues, I was appalled by the findings of the independent review and the allegations of sexual harassment and interpersonal misconduct that have been festering at the FDIC for far too long. The report paints a picture of an agency plagued by a toxic culture that has allowed inappropriate workplace conduct to persist without accountability. Despite the purported efforts under both Democratic and Republican administrations to address these ongoing issues for more than a decade, hundreds of current and former FDI staff bravely shared stories of workplace misconduct with the authors of the report, with some, in fact, going to great lengths to hide their identity. As someone who's led successful organizations and teams, I know that an organization's culture starts at the top, and we need agency leaders who comprehend the problem and are committed to implementing and following through the meaningful reforms that will ensure our agencies can attract and retain dedicated staff. Our banking regulators have important work to do, much of it we will be highlighting today, but it is essential to the success of that work that meaningful action is taken to address these long-term personnel issues. I encourage my colleagues to take the time to fully review the facts of the situation. Thank you, and I yield back.
Today, we welcome the testimony of the Honorable Michael S. Barr, Vice Chair for Supervision of the Federal Reserve Board of Governors, the Honorable Martin J. Gruenberg, Chairman of the Board of Directors of the Federal Deposit Insurance Corporation, and Mr. Michael Hsu, Acting Comptroller of the Office of Comptroller of the Currency. You'll be recognized for 5 minutes to give an oral presentation of remarks. You all are accustomed to this, testifying before this committee. Without objection, your written statements will be made a part of the record. And without objection, the statement of the Honorable Todd Harper, Chairman of the National Credit Union Administration, will be included in the record as well. He is not here today because of exigent circumstances, made well aware of the committee well beforehand. So we'll include his testimony without objection. Finally, before we begin, I will swear the witnesses in. So if you'll please stand and raise your right hand. And once I read the oath, I will ask each of you to respond individually. Do you solemnly swear or affirm that the testimony you will give before this committee in the matters under consideration will be the truth, the whole truth, and nothing but the truth, so help you God? Again, Mr. Barr, Mr. Gruenberg, Mr. Hsu. Thank you. You may be seated. The record will reflect each witness answered in the affirmative. We'll now recognize Vice Chair Barr for 5 minutes to give an oral presentation of your remarks.
Chairman McHenry, Ranking Member Waters, and other members of the committee, thank you for the opportunity to testify on the Federal Reserve's supervisory and regulatory activities. Accompanying my testimony is the Federal Reserve's semi-annual supervision and regulation report. Today, I will discuss current conditions in the banking sector, supervisory activities, and some of our recent regulatory proposals. Overall, the banking system remains sound and resilient. Banks continue to report capital and liquidity ratios above minimum capital regulatory levels. Overall asset quality remains generally sound. Capital ratios increased throughout 2023, leaving the system better positioned to weather potential losses. Liquidity conditions overall are stable. Notably, liquid assets on bank balance sheets remained above their 10-year average throughout 2023. Additionally, there has been a decrease in the share of uninsured deposits in the system. However, both supervisors and banks must remain vigilant and ready for expected and unexpected stresses, and presently there are several risks we are monitoring. For example, delinquency rates are rising among certain commercial real estate loans, such as those backed by offices, and some consumer loan sectors. CRE delinquencies are now at a 5-year high. Credit card and auto loan delinquencies have been rising. In response to rising delinquencies, banks have increased loan loss provisions. On this basis, combined with their capital positions, the banking sector as a whole should be prepared to absorb loan losses that may materialize and continue fulfilling its vital role providing credit to households and businesses. The Federal Reserve continues to monitor these conditions closely. It has been a little over a year since the sudden failure of SVB and ensuing stress in the banking system, events which highlighted the need to improve the speed, force, and agility of supervision to better align with the risk, size, and complexity of supervised banks as appropriate. We have been making progress on these goals. First, we are working to ensure supervision intensifies at the right pace as a bank grows in size and complexity. Second, we are modifying supervisory processes so that once issues are identified, they are addressed more quickly by both banks and supervisors. Third, we are finding ways to better incorporate forward-looking risk analysis into supervision. The lessons learned from SVB are not only applicable to our supervisory framework. Certain aspects of the failure show that enhancements to our regulatory framework would benefit the safety and soundness of the banking system. One of these enhancements was already in process several months before SVB's failure through an advance notice of proposed rulemaking, expanding the application of long-term debt requirements to additional large banks. Subsequently, the board, the FDIC, and the OCC followed up with a proposed rule that would increase the options available within the resolution process and enhance financial stability. We are going through comments we received on this proposal carefully. Another important area is liquidity risk management. A striking feature of last year's bank stress was that SVB, Signature Bank, and First Republic struggled to cope with unprecedented deposit outflows. Banks found it difficult to monetize their held-to-maturity securities through repo transactions under severe stress, and were not adequately prepared to utilize the Federal Reserve's discount window. We are exploring targeted adjustments to our regulatory framework that would address each of these concerns: deposit outflows, held-to-maturity monetization, and discount window preparedness. The Federal Reserve's lending to banks through the discount window plays an important role in supporting the liquidity and stability of the banking system and the effective implementation of monetary policy. We are reaching out to a wide range of depository institutions of all sizes to learn from their experiences with the discount window in order to improve our operations. Turning to capital, a safe and sound banking system is critical to a healthy economy, and capital is foundational to safety and soundness. A well-capitalized banking system reduces the probability that stressful conditions result in financial crises, which inflict devastating economic costs and suffering for families and businesses all across the country. Since my last testimony, we have received numerous and meaningful comments on our proposal. We also received additional data. We are closely analyzing this information, and I expect that we'll have a set of broad material changes to the proposal that allow us to have a broad consensus in moving the proposal forward. The changes will enable us to have a safer financial system that better serves American households and businesses. Thank you.
Chairman Grunberg, you're recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman McHenry, Ranking Member Waters, and members of the committee, thank you for the opportunity to appear before you today. My written statement reports on the state of the banking industry and the condition of the FDIC's Deposit Insurance Fund. The written testimony also provides an update on FDIC resolution activities and discusses proposed improvements in regulation and supervision. However, I would like to focus my remarks today on the FDIC's ongoing efforts to transform its workplace culture. Let me begin by saying that I am deeply committed to the FDIC and its mission, as well as to the people on whom that mission depends. That is why, when reports of sexual harassment, discrimination, and other misconduct surfaced last year, it was essential as a starting point to gain a deeper understanding of the agency's workplace culture. At my direction, the FDIC initiated an independent third-party review to determine the depth and extent of these issues. Last week, the results of that review, which was conducted by the law firm of Cleary Gottlieb, were released. The review found that for an extended period of time, the FDIC has failed to provide a workplace safe from sexual harassment, discrimination, and other personal misconduct. I accept the findings of the report, and as chairman, I take full responsibility. To anyone who has experienced sexual harassment, discrimination, or other misconduct at the FDIC, I again personally want to apologize and express how deeply sorry I am. I also acknowledge my own failures as chairman, both in failing to recognize how my temperament in meetings impacted others, and for not having identified the deeper cultural issues at the FDIC sooner. I am personally committed to addressing these issues. We accept all of the recommendations of the report and are incorporating them into our existing action plan for a safe, fair, and inclusive work environment. To restore credibility to our workforce, we must act swiftly on the report's recommendations and demonstrate a commitment to making fundamental change. For this reason, we are already implementing several key recommendations of the report. The report recommends that we identify and appoint a transformation monitor who will monitor, audit, and report on our implementation of the recommendations. We have already begun this process and will issue a request for proposals for this purpose as early as this week. The report also recommends that we engage an independent third-party expert to support our efforts. We have begun that process and will also issue a request for proposals for that purpose as early as this week. The report recommends fundamental change to the agency's structure and procedures for receiving and investigating complaints and taking disciplinary action against misconduct in light of the failures of the existing offices delegated those duties. We will do this by proposing the establishment of an independent Office of Professional Conduct, which will report directly to the FDIC Board of Directors. It will be charged with fulfilling these responsibilities, including through the use of outside third parties to conduct investigations. The Transformation Monitor, an independent third-party expert, will advise us on this proposal. Since December, the FDIC has been focused on implementing its action plan to address all aspects of the issues raised in the news reports last year. The action plan represents an agency-wide effort with participation by employees at all levels. Many of the recommendations outlined in the report are already encompassed by the agency's action plan. The action plan is focused on 3 core elements: providing more support and resources to victims, strengthening our process for reporting and investigating complaints, and improving accountability for anyone who is found to engage in misconduct, including through separation from the agency. The new Office of Professional Conduct will address these core objectives. Mr. Chairman, it is my privilege to lead and work alongside everyone at the FDIC. Our people are dedicated to the agency and its mission. They deserve a workplace where all feel safe, valued, and respected. There is no higher priority for me than delivering on that commitment. Thank you, and thank you for the additional time, Mr. Chairman.
Mr. Sue, you're recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman McHenry, Ranking Member Waters, and members of the committee, I'm pleased to appear today to provide an update on the activities and priorities of the OCC. The overall condition of the federal banking system is sound. OCC-supervised banks, in aggregate, continue to have strong levels of regulatory capital and sufficient liquidity buffers, though risks from commercial real estate and interest rate exposure continue to warrant attention. Banks and supervisors need to remain on guard against complacency, one of my top priorities for the agency. The OCC's Bank Supervision Operating Plan for 2024 highlights asset liability management, credit risk and allowance for credit losses, cybersecurity, operational risk, and consumer compliance risk as our key areas of focus. Another priority for the OCC has been promoting fairness in banking. This April marked the one-year anniversary of OCC guidance to assist banks in managing risks associated with overdraft protection programs. Since the OCC's heightened attention on overdrafts began, the overdraft fees charged by OCC-regulated banks in aggregate have fallen over 40%. Adapting to digitalization has been a third priority for the agency. We recognize, for instance, that community banks may face hurdles in risk managing their third-party relationships, including with fintechs. Earlier this month, the OCC, Federal Reserve, and FDIC published a third-party risk management guide for community banks with examples of innovative approaches to conducting due diligence and assessing new fintech relationships. The OCC supports a diverse and dynamic banking system and continues its focus on updating our bank merger analytical frameworks. We remain committed to working with our interagency peers, including the Department of Justice, on this effort. To increase transparency, on January 29th, we released for comment a proposed policy statement on bank mergers. We recently extended the comment period to June 15. My written testimony provides greater detail on these and other activities of the OCC. As co-chair of the FDIC's Special Review Committee, I would like to address briefly the recently released independent report on harassment and misconduct at the FDIC. The top priority for us all must be protecting the staff of the FDIC and putting people first. The harassment and misconduct detailed in the report are totally unacceptable. The number and scope of allegations, the patterns of misconduct, and the long-standing culture revealed by the review are highly disturbing and need to be fixed. The root causes and recommendations cited in the report provide a clear roadmap for what needs to be done and why. That is where our attention must be focused to ensure the FDIC is a safe workplace for all of its employees. As a member of the FDIC board, I am committed to the transformation called for in the report. I am especially supportive of the report's recommendation to engage an external expert and establish an independent monitor to ensure that the agency's efforts are tracked and that accountability is enforced. I also believe that Chairman Grunberg has accepted responsibility for his and the FDIC's past failings, and that he is fully committed to lead the agency in taking the actions necessary to make it a safe place for everyone to work. Thank you. I'll be happy to answer any questions.
Well, thank you. I'll now recognize myself for 5 minutes. Vice Chair Barr, if there are significant changes to your capital proposal, will you commit to reproposing the rule for notice and comment?
We haven't made a decision on process yet. We're really focused right now on getting the substance right.
Do you think there'll be an opportunity for notice and comment after your next, whatever the next proposal is?
Again, we haven't focused yet on the process. We really are still trying to work our way through the substance and make sure we get that right.
All right.
We haven't made any decision yet.
We intend for you to comply with the law of the Administrative Procedures Act.
Yes, we will.
Chairman Grunberg, let me take you through the timeline of the last 15 months. In March, 3 major banks failed, including Signature Bank, which is directly supervised by your agency. In April, your own chief risk officer reviewed FDIC's actions leading up to Signature Bank's failure, concluding staffing, whether it be shortages or communication issues, was a major issue. Later in November, revelations about the workplace environment started to appear. When you testified before the committee, the Wall Street Journal just reported on the toxicity of the FDIC's workplace, describing a culture ripe with harassment and discrimination. 6 months later, an independent law firm commissioned by the FDIC released a report not only confirming your inappropriate conduct, but confirming the toxicity of FDIC's culture and workplace environment by expanding on the magnitude of both. No need to go into the details of the report at this time, but looking back, I can say with confidence that the FDIC's workplace issues played a role in Signature Bank's failures. Would you?
Thank you, Mr. Chairman. I appreciate the question. As you indicated, our Chief Risk Officer did a review of the failure of Signature.
No, I'm asking you.
Yes.
Do you believe that the workplace issues impacted the Signature Bank failure and the response to it?
I'm indicating, Mr. Chairman, that the report did not identify that as an issue.
I'm asking
Yeah.
you, do you think that is the case?
I
You don't need to cover all this stuff to use time.
As far as I'm aware, it was not a significant contributing
Okay,
factor, Mr.
so let's run through the scenario. This report that you accept the report from Cleary Gottlieb,
I do.
including the claims of your actions to your direct reports and folks in the agency.
I do.
You accept that?
I do.
Okay, so the workplace environment you have, and the report indicates that when presented with bad news, your first reaction is to yell, scream, or berate the person presenting the bad information. Do you think a bank failure is bad information?
It is.
Did you remember responding to that bank failure weekend with any level of anger?
No.
No anger?
No.
Okay, so the report indicates that you're predisposed to pure anger and rage when presented with bad information. You accept that as part of the findings of the report?
I do accept the findings of the report,
Okay,
Mr. Chairman.
and so we're to believe that in the weekend where we had 3 major bank failures, that you were not angry, and you did not get angry when presented with bad information.
I did not, Mr. Chairman.
Okay, you've led the agency for 10 of the last 13 years. We've had significant bank failures. Do you think that the fact that you respond to bad information by attacking or yelling at the person presenting that information makes those people less willing to present bad information to you?
I endeavor to treat every employee with courtesy and respect.
That's not what the report indicates, sir.
No, I'm
and that's
trying-
why I'm asking this specific question. If you berate the people you ask the question of,
I think the report indicates that even in circumstances in which I treat employees harshly in a conversation, employees still bring bad news to me.
okay, the report indicates, one senior executive put it, there is a great reluctance to deliver bad news to Marty Grunberg. And a number of employees, including senior executives, noted that this reaction could have the effect of chilling open conversations and that his behavior hampers free flow of communications. You've led the agency for 10 of the last 13 years. Your behavior is such that you apologize for folks in the agency experiencing harassment and sexual harassment, but you never have apologized in your written statements and press reports or here before this committee for your actions in this report. There is no apology for the people that you've berated over the last 13 years at the agency, or actually the last 20 years at the agency, but you leading it for 10 years. Do you apologize to the people that you affected?
I certainly do, Mr. Chairman,
You certainly do.
and I take responsibility for
Okay.
it.
You take responsibility for it, but you do not apologize?
No, I said I do apologize.
Okay, all right. I'll now recognize the ranking member for 5 minutes.
Chair Gruenberg, at a hearing last November, after the Wall Street Journal articles were published, I asked you to provide an action plan outlining the steps the FDIC plan to take to address workplace issues related to sexual harassment and misconduct, and to ensure that all employees are provided a safe work environment. On December 1st, 2023, you provided that plan, which addressed 8 major areas and contained over 30 specific tasks to be completed under those general areas. Approximately half of the tasks were to be completed by this time, and the other half were to be completed before the end of 2024. Which tasks have been completed and what improvements have come from them?
Thank you, Congresswoman. As I indicated, we initiated that plan in the immediate aftermath upon learning about these matters. I directed a third-party review. That review has now been completed. In addition, the action plan had a number of specific action items that we have been in the process of implementing, including increased protection for victims, a hotline, a training program, pulse checks in regard to workplace culture, and a range of other action items that we have been in the process of implementing, and as you indicated, will complete by the end of this year. In addition, after receiving the new report that was released last week, we have already begun to implement the core recommendations of that report, including action to retain an independent monitor, to audit our implementation of all recommendations, to retain a expert third party to advise us on our culture change efforts. And I've indicated the core objectives that we are trying to address for the agency are to strengthen the ability of employees to report misconduct, to provide independent investigations of misconduct, including by third parties, and to strengthen our disciplinary process so that there is swift and certain justice for victims appropriate to the misconduct that's occurred, including separating individuals from the agency. And I might also indicate that this year 4 individuals have been separated from the agency for misconduct. We have made management changes in key positions relating to this issue, and the implementation of a new independent Office of Professional Conduct will result in significant additional management changes by the agency. We are committed to transformational change, to the structural change that I believe is the core recommendation of the report, and we have already begun to implement that.
So what you're saying here in committee today is that you have implemented the plan. Some of the tasks included in that plan have been completed. There's still more to be done, but you can see the results of the work of that plan already. Is that correct?
I think we can see certainly strengthened resources for anybody who's victimized, a hotline for anyone to report or seek assistance. We've instituted a training program for all 6,000 employees, which is already well underway and has already trained a significant number of our employees. And we are following through on all of the action items in the plan.
I believe that employees must feel free to engage in discussions and to give complaints and have their concerns dealt with. Do you sense in what you're doing, you're opening up that opportunity for employees?
I believe we are. We have enlisted employees across the agency in participating in the implementation of the action plan. We offered expressions of interest to employees in Washington, as well as our regional offices, to participate. Many are. I think the agency across the board is deeply committed to addressing these issues and to following through on implementing the action items.
Thank you very much, and I yield back.
Gentlelady yields back. We'll now recognize the Vice Chair of the full committee, Mr. Barr. Sorry. You're the Vice Chair of the Fed. We'll now recognize the Vice Chair of the full committee, Mr. Hill, for 5 minutes.
I thank the chairman, and thank you for calling this hearing with our Prudential regulators. And Chairman Grunberg, before I get into the more substantive part of my discussions, you and I had a discussion on the phone, and I said since the 1990s, the federal supervisory agencies have held financial services companies to an incredible high standard about workforce practices, human resources practices, diversity training. It's a part of the routine review of bank regulators, of regulated institutions. And so, as I said to you on the phone, I think this is a horrible double standard that here 35 years later, 30 years later, we're having this kind of discussion about a federal agency that's at the epitome of leadership in the financial oversight and supervision. So I find that really disappointing, and that's why I've joined my colleagues in suggesting, I think in the best interest of banks and the agency itself and your employees, that you step down as chair. You answered a question to Chairman McHenry that somehow you did not get angry, but I'm looking at the report itself around the time of Silicon Valley's failure. May 2023, there was a meeting intended to cover corporate governance related regulations with the chairman. He switched topics to talk about bank failures. And according to one of the participants, Chairman Grunberg went on a rant for 45 minutes, directing his ire at a particular individual, threatening that he could fire or reassign anybody he wanted. The meeting was so uncomfortable that the person who felt targeted by the chairman sent a Teams message out to everybody who was on the telephone. So I want to say I'm not sure you answered that question truthfully. You want to respond on that to the chairman?
Yes, Congressman. I believe the question directed to me was on that initial weekend of the failures, and I was responding to that. I take the point you raised in regard to the meeting in May, which was well after that, as you know.
Yeah, well, I mean, I don't think we should parse words here. I think I don't consider that responsive. I think the chairman asked an open-ended question. Let me turn to Vice Chairman Barr. As you know, the courts have previously invalidated agencies' rulemaking where the final rule was not a, quote, logical outgrowth, close quote, of the proposed rule. You got a case like that. Also in broker-dealers in the SEC in 1993, Tim Pinero versus the SEC, and the Investment Company Institute and the CFTC in 2013, and Investment Company Institute versus the CFTC, where the agency's final rule deviated so much from the proposal that the court concluded that commenters weren't given an adequate opportunity to have feedback. In other words, if you're going to try to fix a bad proposal, the public must have a meaningful opportunity to comment on these unanticipated change. Bloomberg and other outlets have reported that the agencies that all three of you represent today have, quote, already decided to adjust the original proposal rather than start over. So let me start with you, Vice Chairman Barr. Have the agencies already agreed to tweak the existing proposal and not start over and repropose?
We haven't made any decision at all with respect to the process, as I indicated to the chair. When that Bloomberg article came out, the Federal Reserve issued a statement indicating as such. We are very much focused on the process. We're still...
Let me ask Chairman Grunberg, have the agencies among themselves decided that in fact they're going to just simply tweak this rule and make it final and not repropose? Yes or no?
No, Senator. No, Congressman.
Mr. Sue?
No.
Very good. Well, that's helpful because Chairman Powell, I think, made very clear that there's substantial changes that need to be made to this rule, and I think to this committee, many of us believe that means this rule should be reproposed. All three of you are members of FSOC, and you probably heard Secretary Yellen's call last week that suddenly that we need to establish a new federal bailout fund for mortgage servicers. Did you hear that comment, Vice Chair?
I'm not sure I would have characterized the comment in that way, but the FSOC did issue a report on non-bank mortgage servicers that highlighted risks associated with.
But did she not call for a federal fund to support them in case they got into financial trouble?
The FSOC report had a set of recommendations. One of those was for Congress to think about an industry-funded liquidity facility.
Okay, let me reclaim my time on that. And let me remind all of you that why are we in this boat? Because Dodd-Frank pushing the mortgage servicing business out of the depository institutions that were regulated, had high capital, had regular supervision, and shifted it to the non-bank sector. Would you say that was a primary cause? The Dodd-Frank Act did create that incentive, Mr. Barr?
I think there were a set of factors that gave rise to...
But that was one of the factors. Would you agree with that?
I think that one of the factors was the way in which technology changed and the economy changed.
I'll yield back, Mr. Chairman, but we'll have questions for the record on that topic.
Gentleman from California, Mr. Sherman's recognized for 5 minutes.
Mr. Chairman, I would hope that we would have a separate hearing devoted exclusively to the horrendous revelations at the FDIC. What we have here is this Hobson's choice of using our time to focus on how 6,600 employees of the FDIC have been treated and how we're going to dramatically affect the entire economy. And I'm going to focus on the latter, but I hope we have a hearing where we can focus on the former.
I'm happy to accommodate the ranking member.
And my concern, especially for Mr. Barr, is that this overall approach, first, it's being sold as if it's conforming with a European or international standard, but actually we're going to have much higher standards than Europe. That means less lending. But then we're going to have these higher standards, but then we're going to have lower standards than we should have for money going to Wall Street. For example, we ignore the interest rate risk on long-term bonds that are in the, quote, hold-to-maturity account. I want to commend you for at least dealing with the available-for-sale account, but Wall Street investments, as we learned from Silicon Valley Bank, it is the interest rate risk that's the big risk, and that risk is undercounted. What we also undercount is we have only a 65% rate for loans to publicly traded companies, where an equivalent company that isn't publicly traded, the 100% rate. There are many ways to raise money on Wall Street, but that local pizzeria can only raise money from the bank, and anything that makes that loan less likely to happen concerns me. But I also want to focus on the discount. There are rumors or reports that you're going to change the rules for discount window. I would hope that you'd make that window more available to small and medium-sized banks and make the technological changes necessary. But the proposal is that the amount of capital that would have to be pledged would relate not just to the amount being borrowed, but whatever the bank had in uninsured deposits. And that you'd end up with the absurd circumstance that if a bank wanted to borrow $1 million, but happened to have $1 billion in uninsured deposits, it would have to pledge $400 million in capital to make a $1 million loan, to borrow $1 million from the. Can you assure me that the amount of capital that you have to pledge to borrow from the discount window will relate to the amount you're borrowing from the discount window and not based on the total uninsured deposits of the bank?
Thank you, Representative Sherman. You've touched on quite a number of topics. I'll say on the credit side, first of all, with respect to capital.
If you could just focus on the question I asked, I have a limited time.
The question related to discount window preparedness, we're working through the substance of that now. We are looking at a range of measures to make sure that banks are ready to use the discount window, and one of those
Can you assure me that the amount of capital you pledge will relate to the amount you borrow from the discount window, and that this will not relate to just the general balance sheet of the bank?
We are looking at
It's a yes or no question, sir.
We are looking at a range of ways to think about.
Okay, so that's not an assurance, and the absurd example I just gave you could, under your answer, be the new rule.
I'm not sure I fully understood the nature of the example, but we are looking at a range of ways of making sure that banks have enough discount window preparedness.
We would make it possible for mid-sized banks to accommodate charities and businesses that have to have accounts of over $250,000 for operations. I'm concerned about the effect that these new rules are going to have on our capital markets, but I do want to focus on that 65% rule. You apply it to publicly traded borrowers, but what about what about mutual funds, pension plans like CalPERS? Is there any reason they wouldn't get the 65% rate?
We are looking at comments on all these issues with respect to the proposal. We received very helpful comments on credit risk, including the issues you raised with respect to pension funds and mutual funds.
Can you assure me that you will treat clean energy tax credits just as we currently treat low-income housing tax credits?
We got very helpful comments on the tax credit provision, pointing out, for example, that the return to the investor is not based on the equity investment, but really on the tax credit return. So that is a useful piece of information for us as we're thinking about
I would
these
hope
rates.
that you would design these rules so that banks will lend money to small businesses rather than simply put their money in highly risky, long-term bonds sold on Wall Street, and I yield back.
Gentleman yields back. We'll now go to the gentleman from Oklahoma, Mr. Lucas, for 5 minutes.
Thank you, Mr. Chairman. There are certainly many issues that deserve our attention today. It's been concerning to hear that the report on the severity of the cultural issues at the FDIC and workplace problems at the chair level. From the report, it appears that repairing this situation will be an all-consuming task. If this same activity had occurred at a financial institution by a bank executive, I can only imagine how the response would be dramatically and very different. Confidence in our banking regulators matters. Leadership matters. In addition to the top-down cultural overhaul, there are many important policy issues that the FDIC must be focused on that impact all sectors of the economy. The actions of the banking agencies have a profound effect on the folks back home. One particular area of concern I've focused on is the Boswell proposal's impact on our ag and energy producers, which our constituents depend on to keep food and power both affordable and reliable. The proposal that has generated an unprecedented response from all sectors of the economy. And Mr. Chairman, I'd like to enter a few letters into the record that discuss the impact. A joint agricultural trade association letter, a joint energy trade association letter, and lastly, a letter from the American Public Power Association and the National Rural Electric Cooperative Association.
Without objection.
I hope you all have the opportunity to review these comments and others from sectors of the economy that typically wouldn't be compelled to weigh in on these issues, which speaks to the breadth and consequences of the current proposal. Another thought along those lines, I'd like to further underscore a consequence from the Boswell endgame proposal that stems from the increased capital requirements to engage in client clearing activities. In Dodd-Frank, Congress mandated central clearing as a way to reduce risk in the system. However, the number of banks that can clear derivatives for end users has reduced over time, making it more difficult to find a bank to offer this service. And I have a real concern that the Boswell requirements will significantly constrain the capacity of banks to offer central clearing. We should be careful not to reduce market access, particularly at the same time that the SEC is mandating clearing in the Treasury market. I've spoken with Chairman Powell, Secretary Yellen, CFTC Chairman Brennan about this issue, and they've all assured me that this is an area they're following closely. First to Chairman Grunberg and then to Vice Chairman Barr. Clearing is a risk-reducing function for the market, but the endgame proposal actively penalizes that activity. How do you reconcile this policy contradiction?
Thank you, Congressman. That is one of the key issues in the report. Clearing and derivatives was a major focus of attention during the 2008 financial crisis and has been a focus of attention in the Basel Capital Accord. We have received a lot of comments on this issue. I acknowledge the points you're raising. This is still a work in progress, as Vice Chairman Barr has indicated. We are taking careful attention to all of the comments we received, including in regard to this.
Vice Chairman?
We're taking those comments very seriously. I agree with you that central clearing is an important way that we reduce risks in the financial system. We've received comments on client cleared derivatives in a number of areas of the proposal, and we're taking those quite seriously.
I believe your agencies have a responsibility to ensure that bank capital standards do not unnecessarily discourage central clearing. Market participants on the clearing side and the end user side are warning us of what's to come. Again, I urge a complete reproposal here. Make the material changes necessary and then allow Congress and the public to weigh in. The consequences of getting this wrong are too severe. Now, in my remaining time, another issue I've heard concerns about is the FDIC's corporate governance proposal. The guidelines as proposed would be a significant departure from existing practices. The proposal is aimed at banks with much lower asset size than the corporate governance regimes at Fed and OCC, are so far more prescriptive. Board of directors play an essential leadership role for a bank and should be held to a high standard. Chair Grunberg, could you elaborate on this and clarify if it is a high priority of yours to ensure the proposal is in line with the OCC and Fed?
Thank you, Congressman. It is a proposal for comment. We are receiving comment. In that proposal, we indeed indicated that institutions over $10 billion would be subject under the proposal. We did consult with the standards used by the Federal Reserve and the OCC, which set a $50 billion standard. We're receiving comment on that, and that is something we are paying attention to.
My time has expired, Mr. Chairman. Thank you.
Gentleman from New York, Mr. Meeks, is recognized for 5 minutes.
Thank you, Mr. Chairman. You know, I kind of agree with Mr. Sherman. I wish I had another opportunity to have 2 phases of this. I would love to talk about some of the substance of the economy, but as I sit here right now, if I'm going to be honest, I'm pissed off. I heard people talk about upset, appalled, but I'm pissed off. That's my language and where I come from. And I'm pissed off because the very idea that employees suffered from racial and gender discrimination, bullying, mistreatment, and harassment at the FDIC for years. And as I see in the report, not a single one resulted in a removal, reductions in pay grade, or any discipline more serious than a mere suspension. That's who I am. I've advocated for workers. I've advocated for diversity, equity, and inclusion my entire career. So I can't sit up here and say that I'm all right with it, because I'm not. It concerns me greatly. If I was me in my office, I'd probably be run out. I don't understand. Maybe you can tell me, how can trust and credibility come back to that agency for all of the workers that were denied and people who may want to work at the FDIC? How can that trust and credibility be returned under current leadership?
Thank you, Congressman. We are devoting all the resources of the agency and engaging employees across the agency in addressing this issue. There is no, if I may say, no higher priority at the FDIC.
Why wasn't something done? When did you find out about this report? When did you find out? When was the first time did you find out about the special committee's report that was revealed on November 21st, 2023?
You're referring to news articles last year. The special report was just released, I believe, a week ago.
When the news articles, so therefore the investigation took place. When was that first? Was that the first time you heard about harassment or anything of that nature?
For the deep-seated workplace culture issues identified that were in those news reports, I immediately directed the third-party review to get an agency-wide assessment from an independent source to understand the nature of the challenge we were facing and what we needed to do. And that report was released last week. And it has given us, if I may say, a line of sight into the nature of the issue that we have not had.
What I don't understand is, number one, how it could take place for all the years that it took place. And admittedly, you were not the chairman the whole time, but you've been there forever. And I would think that if someone would see that type of harassment, those type of activities taking place, somebody should stand up, especially if you are in a leadership position, and say something. And I believe I do have the responsibility of holding everybody that comes before us in accountability. Let me ask Mr. Sue. Now, you and I believe Mr. Jonathan McKernan was co-chairs of the special committee. That's correct?
Correct.
And I heard you say in that report, there is a report about some of the specific emotions, I'll say, the loudness or conduct of Chairman Gruenberg. Is that correct?
So the report cites 10 root causes of all of the issues that you, that are deeply disturbing. Chairman Gruenberg was not cited as one of those root causes. There are a lot of causes, and they all require work. They require an enormous amount of cultural and structural transformation.
So let me just run out of time. Do you think that the current leadership can restore trust and credibility at the FDIC?
I do.
And let me ask you this question. Do you think that the 3 women that was added onto this committee were added into the committee enough times that they have meaningful participation in the committee's works?
I do.
You're back to bouncing my time.
Gentleman from Texas, Mr. Sessions, is recognized for 5 minutes.
Mr. Chairman, thank you very much. Gentlemen, I have on my door in Waco, Texas, our district headquarters, when leaders sell ambiguity, it dismisses the role of leadership. I think you guys sell ambiguity. I think all 3 of you sell ambiguity. Mr. Sue, were you aware that in July 2020, a report found that the FDIC had not established an adequate sexual harassment prevention policy?
If you're referring to the FDIC OIG report, yes,
I
aware.
am.
Yes.
So why did you try and parse the words about which month this was and whether it was just the other day or not? Just in the conversation you had with Mr. Meeks, you referred to, well, 2024. You didn't say 2024. You alluded to just the other day. You didn't say just the other day. It became apparent that you were talking about of recent times.
I'm sorry, sir. I'm not
Mr.
sure.
Sue, did any of these employees that are presented here, did they report to your organization?
I'm sorry, can you repeat the question?
Within your line of management, did any of these employees that are mentioned here in this report? That's a yes or a no, Mr. Sue.
Well, I want to make sure that I'm complying with privacy laws.
Did they report within your organization?
I'm sorry, sir, I can't answer this question.
Oh, you can't answer that. Let me go back and tell you, when leaders sell ambiguity, it diminishes the role of leadership. I'll expect for you to write us an answer that yes or no, that I will hold private to me, and I'd like the chairman and the ranking member to get that also. Mr. Barr, did any of the people that are mentioned in here report within your organization?
My understanding is the report focuses on the FDIC. I don't have any information.
Okay. So were you aware of a July 2020 report from the Office of Inspector General that specifically said that the FDIC had not established adequate sexual harassment program?
I learned of that report, not in 2020, but I am aware that there was such a report.
What year do you think you learned about this as a problem by the Inspector General?
At the FDIC?
Well, yes.
I don't know. I mean, I learned about it at some point after joining the Federal Reserve Board in 2022, but I couldn't tell you exactly when. The report is about the FDIC, not about the Federal Reserve.
So have you looked at it in context of your organization?
The Federal Reserve has a very strict zero tolerance policy for sexual harassment and discrimination.
This is what I'm getting at. So your organization had this as a very strict policy. Why do you think the FDA, Mr. Chairman, Mr. Greenberg, why did your organization not have a strict policy therein?
We had a policy at the time in
A
compliance.
strict policy, Mr. Greenberg.
The IG report found shortcomings in our policy. They had 15 recommendations that I believe the agency addressed. If I may say, in
That was
retrospect.
back in 2020.
Yes, that's what I'm referring to. The IG report from 2020.
I am. So why did you have to go and hire an outside firm to tell you what the IG had told you? Did you not want to accept what the IG had said?
I believe the agency at the time did accept the findings of the report. That 2020, if I may just say, Congressman, that 2020 report did not identify the type of deep-seated cultural issues that this recent report has,
Is that right?
and that the news stories last year identified.
So these were things then that came as a result of your leadership then. They were brand new.
I think the report, the new
Now,
report.
that's what you're suggesting to me. That wasn't old. This is all new.
No, well, if I may say, Congressman, the report indicates that these are longstanding challenges for the agency. I'm simply indicating that the 2020 report did not identify the nature of the deep-seated cultural nature of the issues. And that came along later.
Mr. Chairman, I find this very disturbing. I find that there is a lot of ambiguity and lack of acceptance of this, and yet I find that they openly say, we'll take responsibility. I see very little responsibility. I yield back my time.
Gentleman yields back. We'll now recognize the gentleman from Georgia, Mr. Scott, for 5 minutes.
Thank you, Chairman. Mr. DeBar, I want to talk to you about this complex and complicated issue, and especially the impact that it's going to have on two groups, our lower income people and our banking system. This business of lowering the caps on debit card interchange fees will definitely hinder the bank's ability to offer low-cost and no-cost bank accounts to low and moderate-income Americans. Are you aware of this, and what do we do about it?
You raise an excellent point, and I've spent a good bit of my career focused on issues of trying to improve access to credit and financial services for low and moderate income people. The Regulation II requirement is a requirement that Congress set out for the Federal Reserve to determine that fees are reasonable and proportional to the costs incurred that are specified under the statute. And the Federal Reserve has made a proposal to update that rule. We have received lots of comments on that proposal, including the kind of comment that you very, I think, appropriately laid out. And we're in the process of thinking about those comments and deciding what to do next.
And I'm also concerned about our small business owners and their incurring costs from debit card swipes on a regular basis. Now, as I said, this is a complex problem. It's something that does not need to be rushed into. I don't agree with it, but my question to you is, if the allowable fees on debit card swipes are lowered, does the Fed share the bank's concerns? Our banks have big concerns on this about the availability of low or no-cost bank accounts for consumers, or are these concerns overstated?
We've just finished the comment period, so we're in the process of receiving those comments. We take them very seriously. We're reviewing them now. I don't have an answer to your question yet, but those are the kinds of comments we'll take quite seriously in the stage of the proposal that we are.
Mr. Chairman, I would hope that before we move on anything dealing with this, that we get a total understanding of the impact on low income and on our small businesses, because it's clearly complex, it's complicated, and you rush into these things unprepared, and you cause great havoc. We did that with Dodd-Frank. And when we moved, we wanted to bail out the big banks first. Until I raised that objection to the president. I said, President Obama, I'm not voting on this Dodd-Frank here. And he said, why? I said, because you can't solve this problem bailing out the big banks or looking at it haphazardly. We got to do something about the homeowners who are having mortgages combined with these high rates of unemployment. Those were the consequences of it. And luckily, he told me, go to work and do something. We came back with hardest hit. I think we probably need to do the same thing with this approach. I yield back, Mr. Chairman.
Gentleman yields back. We'll now go to the gentleman from Florida, Mr. Posey, for 5 minutes.
Thank you, Mr. Chairman. I'd like to yield to the gentleman from Kentucky, Mr. Barr.
Thank you, Mr. Posey. And Mr. Sue, I'm sure that you've seen the Cleary report on the toxic workplace at the FDIC and the temperament of your colleague, Mr. Gruenberg. Keeping in mind that you have a duty to be truthful to Congress, can you testify whether there have been any occasions in which Mr. Gruenberg has directed anger and ill temperament toward you, including in discussion on the 2021 effort by Mr. Gruenberg and Mr. Chopra related to the Bank Merger Act?
No, not anger. Passion, yes, but not anger.
So you would describe the heated conversation that you had in 2021 related to the Bank Merger Act as passionate, heated, but not ill-tempered?
Correct.
You have said that you think Mr. Gruenberg is capable of resolving these issues despite what you have witnessed. One of the 6 factors or CAMELS ratings that bank supervisory authorities use to rate financial institutions is the quality of management. If the OCC were to uncover the kind of misconduct identified at the FDIC in the Cleary report at one of your own OCC-regulated banks, what rating would the OCC give to that bank's management on a 1 to 5 scale, with 1 indicating the strongest performance and 5 indicating the weakest?
So the rating is a function of a lot of parts of the assessment. So it really depends on the nature of the weakness, how material it is to the safety and soundness of the.
But you know what I'm getting at, Mr. Acting Comptroller. A toxic workplace, harassment, sexual harassment, discrimination, interpersonal misconduct, replete in the report at the FDIC. If you found that, if one of your examiners found that at a national bank, how would you rate that management of that bank?
We would rate it accordingly.
And what does that mean? Matter requiring attention?
It depends on the severity and the specifics of.
Well, I'm talking about this kind of severity.
This is severe. I agree this is severe.
Mr. Barr, 97% of the almost 400 comments on the Basel III Endgame proposal were opposed to or expressed concerns, with 86% of negative comments coming from outside the banking sector. You've stated publicly and privately to me that the public will be able to comment on the QIS. Given the overwhelmingly negative comments from the proposal from various ideological, parts of the ideological spectrum from across the country and various industries, why is there even a question whether or not the proposal should be withdrawn in full?
Thank you, Congressman Barr. We're looking right now at the substance of what we think about the comments. As I've suggested to you on numerous occasions, we got good, deep, substantive comments. I expect we're going to make broad and material changes across all 3 areas of the proposal: operational risk, credit risk, and market risk. Once we decide on what we think the appropriate substance is, we'll turn to the question of what the appropriate process is. We've not gotten there yet.
And I think that's, and I appreciate that, and I appreciate the fact that the Fed is open to those broad material changes. But to follow on Mr. Hill's excellent line of questioning, the case law in the administrative law area is pretty clear. Broad and material changes require a withdraw and reproposal under the law. So again, why is there any question whether or not there would be a withdrawal and reproposal, giving commenters the ability to comment on the new proposal, the reproposal?
Congressman, as I said, we will follow the law. We will follow the Administrative Procedures Act. There is no question about that. We just haven't turned to the procedural question yet. We're focused right now on the substance.
And thank you for your commitment to allow for comment on the QIS. What is the timeline on the release of the QIS?
Staff are working diligently on that. They're in the process of quality control and review. It will be relatively soon.
Thank you. And Mr. Barr, one final question. And I know you've worked really hard on this, and you and I have gone back and forth, but one thing I'm concerned about is that the proposal will likely raise capital requirements for U.S. financial institutions by more than 20%. And there's evidence that in the EU and in the UK, implementation of the Basel III Endgame proposal would be at a much lower calibration, closer to a 5 to 7% increase. Are you concerned about the gold plating here in the United States putting our institutions at a competitive disadvantage?
We are looking at all the comments we received on this, including on this question of gold plating. I would say at a much higher level, Congressman, it's been my experience that having very strong capital requirements in the United States has been to a competitive advantage to our firms who are thriving in the marketplace.
My time has expired, but remember, the objective of Basel III Endgame was harmonization. Harmonization. With that, I yield back.
Gentleman from Connecticut, Mr. Himes, is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to our witnesses for being here. Chair Greenberg, I despise these congressional pylons for a couple of reasons. Number one, I've always very much enjoyed the working relationship we had in crafting regulation. And number two, the high dudgeon and moral outrage we show up here suggests that we're great managers and excellent at taking responsibility or don't have feet of clay, and there's no evidence for any of that. But we are charged with oversight. And I've read the report, and I have a particularly difficult time with the sexual harassment part of it. I grew up with a single mom and 2 sisters and have 2 daughters and see every day the challenges that women face in the industry and around. So I have a really hard time with some of what we see there. I guess my question for you, sir, is, your opening statement here, you say that when news reports of harassment first surfaced last year, were you completely unaware for the 10 years prior of these allegations, these many allegations?
Thank you, Congressman. I was aware of cases being brought under our normal processes, but the kind of deep-seated cultural issues identified in the news reports last year and in the report that was recently released did not come to light. And as I indicated, I view that as a failure on my part. I simply did not identify the deep-seated cultural issues that were revealed in the news reports and in this recent report. And I will say, once those reports came forward, we've devoted all the resources of the agency since that time to addressing this issue.
So I want to move on because I have other topics, but you've said you take full responsibility. If you were the skipper of a ship in the Navy or a corporate CEO, I have very little doubt what would happen in those instances. But forget about us and forget about the lawyers. I want you to just take a minute because I'm stumbling over this. I'm the right guy to fix this thing. So forget about us and forget about the lawyers. I want you to imagine that instead of us, you're looking at the young woman who was, it was implied that she should be a surrogate for her boss's child, the gay man who felt he had to hide his preferences because he was called a little girl, the women who got photos of genitals. I want you to imagine that we are those people, and just take a minute and tell us, not us, but those people, why you are the right leader to lead these critical reforms.
Thank you, Congressman. I have indeed met with some of the people you're describing. I understand keenly the hurt they feel, the impact these kinds of experiences have, and it is why I am totally committed, and I believe the agency is totally committed. We have been working on this now for several months. I believe we are making progress. I think we are going to be informed, have been informed by the new report. We are already implementing the recommendations of the new report, we can address this issue, and I think it's critical to move forward and address the issues that have been identified, and we have an opportunity to do that now.
Chairman, I don't know how that works for them. I would just ask you, do that. Sit with them and persuade them that you're the right leader. And if they are not persuaded, we don't matter. There's more than a whiff of politics up here right now. We don't matter. If they're not persuaded, I hope you'll do the right thing. Vice Chairman Barr, I look forward to the moment when I don't have to constantly be thinking, emailing, and talking about Basel III Endgame. When are we going to finalize that process?
Thank you very much, Congressman. Right now, as I mentioned, we got lots of comments. They were deeply substantive. We're working our way through that substance. We've made good progress. You've heard me say, you've heard the Chair Powell say, we're expecting we'll make broad and material changes to the rule. I expect those to occur across all three areas: operational risk, credit risk, and market risk. We need to work through that substance, finish working through that substance, turn to the question of what the right process is. But we're not on a timetable that is dictated by anything other than getting it right.
Okay, great. I'll just make the point. We've talked about this a lot. I desperately want to be on your side. I came here in the first quarter of '09. I spent a lot of time worrying about a world where Citibank goes belly up. I want to be on your side, but as I've said a whole bunch of times, I really need to understand the analysis underlying the call for additional capital standards. If I get that, and if it's persuasive, I'll be there, but I just need to get that. And with that, Mr. Chairman, I'll yield back.
Gentleman from Missouri, Mr. Lukermeyer, is now recognized for 5 minutes.
Thank you, Mr. Chairman. This is a very deeply disturbing moment to me from the standpoint as a former bank examiner with the state of Missouri for a couple of years, and having gone to the FDIC school when I was examiner. Of course, I didn't go there when it was the FDIC hotel, as reported by this report this morning. But I have deep respect for the FDIC. Standpoint, I've worked with examiners, both as an examiner and as a banker. But this report, along with the long tenure of Mr. Grunberg, leaves a lot to be desired. It is very concerning. And let's just start with it. An independent third-party report, 167 interviews, where 10% of the people, roughly, complained of abusive treatment. Things like gender and race discrimination are documented, as Mr. Meeks indicated this morning. We got anger management issues with the management of the agency. We have field offices that are fear of reporting for fear of retaliation. How in the world can people do their work if they're fearful of being able to report what's actually going on? It can't happen. We have promotion within the agency based on the club that they're in, which is nepotism. That can't be tolerated. In the report, it's indicated that the FDIC Seidman Center, in the Wall Street Journal article, the FDIC hotel, there are 24 instances of intoxication misconduct occurred, 2 sexual harassment and 1 rape. 2 sexual harassments and 1 rape within the FDIC hotel. And now, this morning, we hear from your testimony, Mr. Grunberg, that you indicate that it just surfaced a little while back, and you just learned of it then, of the depth of this. Sir, there was 92 harassment claims, according to the report. 92. You have to be either totally incompetent or not caring and allowed to go on and be a facilitator of all this activity. 0 resulted in removal, 0 resulted in reduction of pay, and no discipline more serious than a suspension or a transfer occurred. Unbelievable. That is facilitation in its purest form. Now, one of the things that's going to happen here, we're going to try and make sure that Ms. McWilliams, who was interim between your 2 terms, is also a fall guy in this. And the report says nothing about that. In fact, it speaks pretty glowingly about her. I quote, within just 3 months of your departure, sir, your successor built enough trust with employees that they felt they could share their stories. And she began to work on the FDIC's culture problems. They actually are supportive of what she was doing. So the report talks about discrimination, gender and race, sexual harassment, nepotism, and your anger management issues. But we know some more, sir. I've been here a long time. This is my 14th year on this committee. which is a long time. Also know that you lied to me. You lied to the chairman, you lied to this committee about Operation Choke Point. And it took an email where we found you involved before we confronted you, and you admitted it in my office that you were involved in this, and it stopped. Since then, since your new term, you've been involved in it again. Remember the ATM operation? One of you, either you or your individual person, was here along with your 3 representatives and also admitted wrongdoing there. But also, there's weak management from the standpoint of regulation. That's what your job really is, as evidenced by the 3 banks that failed last year. As a bank examiner, there is no way in the world I would have allowed the bank model of those 3 banks to exist. 80 to 95% uninsured deposits? Are you kidding me? No way. You knew about it for a year, did nothing. And in doing that, you endangered not only the viability of those banks, but the viability of our system. Because what happened? They went down, runs were started on other banks around the country. I got phone calls from everybody, all sorts of bankers worried about what's going to happen, all because of lax management and lack of regulation. And Mr. Sue, you're part of the problem as well. You and Chopra and Gruenberg were the 3 that went in behind McWilliams' back and tried to do something with this bank merger situation and managed to oust her. Shame on you guys. Mr. Gruenberg, you have become the Michael Cohen and Harvey Weinstein of the FDIC, and you need to go. If you have the decency, please step down. If not, I would urge the President of the United States to replace you ASAP. And with that, Mr. Chairman, I yield back.
Gentleman yields back. The gentleman from Illinois, the ranking member of the Financial Institutions Subcommittee, Mr. Foster, is recognized for 5 minutes.
Thank you, Mr. Chairman. Acting Controller Sue, last Friday, the FSOC issued a report on non-bank mortgage servicing. And in your statement following your vote to approve that report, you stated that the report identifies important financial stability concerns that need to be addressed by Congress. The press release announcing the report notes that in 2022, non-bank mortgage companies originated approximately 2/3 of mortgages in the United States and owned the servicing rights on 54%. I came in March of 2008, and so I spent a lot of the first years cleaning up the mess of an underregulated mortgage industry and looking at the damage that did to families in America. And this report notes the benefits of this trend, such as supporting lending to historically underserved communities, but also the risks that are associated with it. Could you speak a little bit about some of the risks associated with concentration in this space and other dangers?
Thank you for the question, Congressman. So as the report noted, today mortgage servicing is concentrated in a relatively small number of non-bank mortgage servicers. And there are certain fragilities that come with that. So if there are disruptions to those services, that could have impact on many, many people.
Yeah. Could you be a little more specific? I mean, what is the scale of this concern? Would it have implications for the GSEs, Fannie, Freddie, Ginnie Mac? What would contagion look like in this area that would be a source for potential worry?
So it depends on the nature of the problem that manifests. But as you pointed out, there are strong connections with the GSEs with regards to these mortgage servicers. And of course, the GSEs are then connected to the banking system. So the potential for widespread contagion from issues or problems at the non-bank mortgage service companies could be severe.
Yeah, could you be a little more specific? I mean, what are a couple of example nightmare scenarios where you could have contagion?
Nightmare scenario. Well, so at the very extreme, there could be massive disruption of mortgage servicing, which would really impact a significant portion of the mortgage market, in which case that's billions and trillions of dollars that are flowing through the system that would be disrupted, and that could have knock-on effects onto both GSEs and banks.
Now, the report includes several recommendations for Congress, including providing additional authorities to help firms manage the risk, to promote information sharing between the state and federal regulators, which share the burden here. Can you speak a little bit about how those recommendations, if followed through by Congress, would promote financial stability?
Sure. So one of the primary recommendations is for Congress to strengthen both the supervision and the framework around the non-bank mortgage service companies so they are held to a standard that enables safety and soundness in that market. That's the core of it. That, in addition to that, I think as was discussed earlier, having a industry-funded fund that would provide liquidity as necessary in case there's liquidity issues at those servicers.
So this would be like the DIF or strictly liquidity? How's this, is it liquidity in the sense that you'd pledge assets so that you'd expect never to take a loss on this fund? Or is this something where the industry as a whole would be responsible for replenishing the fund?
Yes, it's more of the latter. And I think the details of that would still need to be worked out, obviously. But the idea is that the industry itself, the non-bank mortgage servicing industry, would fund it.
Okay, and so then I'm immediately led back to Representative Hill's comment about, okay, this, maybe just move this more back into the banks, and there already is a DIF for it, and trying to understand the reason for the market moving the way it has.
So we want to make sure that for any given activity, especially with mortgages, there's risk. And that risk has to be managed and properly buffered for, both for capital and liquidity. We want to make sure that those standards are applied equally and appropriately wherever they take place, whether it's within the banking system or outside the banking system. And the FSOC report really gets at that.
Yeah, well,
We want to level up. We want to make sure that that playing field is level and leveled up.
I have to say that's the FSOC doing exactly the job that we hoped you would do, to actually look around the corner and look holistically at the system and say, okay, are there things that we are going to be having hearings about, next year after things blow up, and to the extent that you're able to foresee and prevent those, you're doing your job well. So thank you, and my time's up, and yield back.
The gentleman from Michigan, the chair of the Oversight Subcommittee, Mr. Huizinga, is recognized for 5 minutes.
Thank you, Mr. Chairman. I want to clarify something that seems to be a well-worn path for some on the committee about this report only being about you because Gottlieb, or Cleary Gottlieb, simply didn't look anywhere else. Sheila Bair was mentioned twice in that report. One, referencing the cultural change she started after a 2008 altercation that you had. Chair McWilliams was referenced 4 times, referencing her attempts to improve the culture, including creating Team FDIC, which stands for Transparency, Empowerment, Accountability, and Mission, to implement a ground-up opportunity for FDIC employees to get involved, cleaning up your mess once again. They had said, Cleary Gottlieb had said in their briefing to the committee that if there was any negative or derogatory information on any of the chairs, they would have included it. They were silent because those 2 women were cleaning up your mess, sir. Now, look, we all know the FDIC plays a critical role in our financial system. Your job as chair is to maintain that stability in the system. You had earlier said to the chairman that your staff regularly briefs you on bank policy or issues related to banks, and that sometimes that bad news is regarding bank failures. What we learned, though, in our own investigation as a committee, we did dozens of transcribed interviews and had dozens of whistleblowers that came forward outside of Cleary. We learned that in our own investigation that senior advisors actively prepared and coached their staff before briefing you, warning them about your behavior. Did you know that? Yes or no? Don't thank me for the question. Yes or no?
No, Congressman.
You did not. Okay. So your staff also shared stories during their interviews that FDIC staff have been known to cry after leaving meetings with you, and that others described having to comfort colleagues after interacting with you. No such stories were documented about either Chair Bair or Chair McWilliams. Cleary Gottlieb found staffers fret and, quote, from the report, delayed delivering news that they feared would upset you and your reactions and did have a chilling effect on open communications, close quote. So let me be very clear. If your staffs are so afraid to give you bad news and they delay telling you that news, it simply makes a bad situation even worse. Sir, you're the wrong person for the job to clean up this mess. The mission of the FDIC is far too important, and you are unwilling or unable to accept negative information. Any delay of information getting to the chairman of the FDIC is a recipe for disaster. If you can't deal with bad news, You are the wrong person for this job. I want to hit on one other important point. Last time, Mr. Grunberg, you were before the committee, you were asked directly by the chair if you had ever been subject of an investigation. You said no. Then after some self-reflection during a break for votes, and I believe a call from a reporter, you admitted that you actually had. Just like you did today, you were parsing your words. Cleary-Gottlieb report explained that the 2008 incident you were made, where you made a senior executive feel personally attacked, the report alleges that the staffer felt embarrassed and humiliated and that you created a hostile environment. And Mr. Chairman, I'd like to include a redacted copy of that 2008 management inquiry into the record.
Without objection.
That person was Arlise Upton Key, while you were vice chairman at the time. And recently you just named an FDIC Chairman's Award for Operational Excellence after Ms. Key, Upton Key. So you named an award after the same woman who you screamed at and the same woman who accused you of withholding information for being disloyal to you. Sir, I certainly hope this isn't some sick ruse to buy her silence. And I'm gonna use your own opening statement to close mine. On page 2, you said this misconduct first surfaced last year. That's simply not true. This had been out there as rumors and innuendo and many other complaints. But you also say you regret not having identified deeper cultural issues at FDIC sooner. Sir, you created the culture. You created the culture there, and you are the wrong person for the job. And you finish on page 3, going on to page 4, the 3 core elements of your action plan outline. Provide more support for victims is your first point. Number 2, strengthen process for reporting and investigating complaints. Number 3, improving accountability for anyone who is found to engage in misconduct, including through separation from the agency. How can this not be you, sir? You're the wrong person for the job, and I yield back.
The gentlewoman from Ohio, Mrs. Beatty, is now recognized for 5 minutes.
Thank you, Mr. Chairman and Ranking Member, and to our witnesses here today. I'm not sure where to begin. I have sat here and listened to my colleagues on both sides of the aisle, and I agree with a lot that has been said on both sides of the aisle. As a Black woman, as someone, when Congressman Hines asked you to reflect on talking to those individuals, and especially women, I was sitting here thinking how I would feel. And then I reviewed again the massive report and the executive summary of the FDIC report. So I'm not going to go through it because much has been said, and rightly so. This is troubling. It is a long-standing culture of sexual harassment and misconduct. I don't know where to start with the blame, but this didn't just happen now. If you go to the middle of the report, which I have spent many hours along with my legal counsel and staff here going through this, the report says this has been going on for years. So now I'm not going to maybe accept whether it was William or Bear cleaning it up. I think all of you all are at fault. I think everybody that sat in that seat has to take some ownership. I don't know what they tried to clean up and right, nor you. But I don't make it just this watch. I am so bothered that 3 of you, to me, share in this. Because this is massive. If we go to the middle of that 300-400 report, there were some 510 hotline reports. And I think it's important for us to know, 97 individuals reported 145 separate incidents of sexual harassment, unwelcome sexual advances. 91 individuals reported 141 separate occasions of gender and sexuality-based discrimination. 187 individuals reported 320 separate incidents of workplace bullying, threat, and verbal abuse. This is not small. Now, I do welcome the fact that you accepted responsibility, that you have put a plan together. But I guess I'm curious, are we gonna go back and look at all these things? Where's the accountability? Was somebody terminated? Will people go back as a result of this and be terminated? And while that won't repair what has happened to some of these individuals, for anyone, but for a female employee to be touched or to have to watch videos, to be asked to carry a child, that is not something that this Congress would accept. This is not a Democrat or Republican, but I want to be fair on both sides. It's not you just as a leader with this administration who should be admonished. Everybody should be admonished. And I guess what I want to hear is let's open up Pandora's box. Let's go look at all those managers. It is from the top down. But there are a whole lot of people that are getting a pass today while we're beating the heck out of you. A whole lot of people should be sitting with you and behind you that should also carry in this blame. So I don't want anyone to think, because I'm all about putting people over politics. People over politics. And that is what I stand for, and I know my colleagues here do as well. So I just wanted to enter the record. I don't think I have a question, but I want you and all those who report under you, you should not carry this burden alone. Now, you should lead it. And everything that has been said on both sides of the aisle, you're going to have to weather because we have it here before us. But I am suggesting that you go back, and a whole lot of other folks need to be responding to the questions that my colleagues are asking to help at least show that we care about all of these individuals that have had to have been exposed to this. And Mr. Chairman, I yield back.
The gentlelady from Missouri, the chair of the Capital Markets Subcommittee, Ms. Wagner, is recognized for 5 minutes.
I thank you, Mr. Chairman. Chairman Grunberg, you've been at the FDIC for 19 years, leading it mostly for 10 of those years. During that time, you apparently never once took it upon yourself to look into the toxic workplace that you're leading. That is until the Wall Street Journal published articles detailing your ill temper and inappropriate behavior towards FDIC employees. After your reputation was put at risk, then and only then did you decide to work on getting your house in order, sir. In this report, 500, north of 500 employees came forward with complaints of sexual harassment, discrimination, and other workplace misconduct. This is a massive number, and it's only scratching the surface. For context, you have over 5,000 employees at the FDIC today. I have a quick answer to these questions, sir. Chairman Grunberg, how often do you get out of D.C. and visit FDIC regional and field offices?
I try to visit we have 6 regional offices around the country, Congresswoman. I try to visit each regional office at least once a year.
One time a year. And the field offices?
Generally not field. We have 70 field.
So you don't go to the 70 field offices once a year to go to the 6 regionals. All right. Do you meet with the employees, rank and file employees, when you have those once a year visits?
Yes, I do.
Did it ever once occur to you that something highly inappropriate was going on at these offices?
The kind of deep-seated workplace culture did not come through in those visits.
You gotta be kidding me. No. Why? How could you not know? You've been there on the board 19 years, and you are telling me that you've never heard a single story of harassment? And sir, I remind you, you are under oath.
Yes, no, Congresswoman, I understand the question and why you ask it. In those visits, I met with employees, rank and file employees. It simply did not come forward.
Huh. Well, this report has some of the most horrific HR abuses that I have ever read in my life. We can talk all day about your personal management problems, and that I find appalling also, but what's more concerning is the complete ignorance and of the well-being of the employees that you're entrusted with leading, and the fact that you don't even visit or talk to them once a year to 6 regional offices, never to one of the 70 field offices. Your employees have lost confidence in you, sir. I have lost confidence in you, and Congress has lost confidence in you. You, sir, should be fired. Not resign, fired. And Mr. Chairman, I ask unanimous consent to enter into the record a letter from the Independent Women's Forum and the Independent Women's Voice requesting the Chair Gruenberg's resignation.
Without objection.
Mr. Sue, your report identified a quote, these are all quotes, Mr. Sue, patriarchal, insular, toxic boys club culture, where there was, quote, widespread fear of retaliation, and where, quote, management's response to allegations of misconduct as well as culture and conditions that gave rise to them have been insufficient and ineffective. The report found that cultural and structural changes were necessary. Mr. Gruenberg has been on the FDIC board for 19 years and been the patriarch for 10 of those years. In those 10 years of leadership, has he failed to address these abhorrent workplace conditions? And what makes you believe he remains qualified to implement the necessary cultural and structural changes outlined in your report?
So as the report notes, what's needed for effective leadership of the agency at this time is leadership that empathizes and fully recognizes all of the problems.
Okay, I don't need a regurgitation. Mr. Sue, your own report states Chairman Gruenberg's reputation raises questions about the credibility of the leadership's response to the crisis and the moral authority to lead a cultural transformation. Do you now renounce the findings of your own report, sir?
No, I accept those findings. I fully accept those findings.
Then how on earth do you believe that Mr. Gruenberg can lead this agency into a new and better day in culture?
I believe Mr. Gruenberg has taken full responsibility for all
No, he
past
has
failings.
not. He doesn't even visit the agencies. He wasn't aware of one single harassment report? My time's expired. I have questions for you too, Vice Chair Barr, but I'll submit those in writing. I yield back.
The gentleman from Massachusetts, Mr. Lynch, is now recognized for 5 minutes.
Thank you, Mr. Chairman. So I come out of the building trades. I was an iron worker for about 20 years, and it is a rough and tumble workplace. You know, we work hard, we play hard. I get that. But, Mr. Gruenberg, this report, you know, makes the iron workers look like Boy Scouts compared to what was going on at the FDIC. Now, rather than using all my time to recount the parade of horribles here and outrageous conduct on the part of FDIC employees, I'm going to ask you. You know, people are spending their time railing at you, and you're not getting a chance to tell us what's the plan here. This cannot continue. You know, I got to tell you, as a former foreman and a general foreman, I would have fired a whole bunch of people at the FDIC. I would have just fired them flat out. And you need to fire some people. If you're going to clean this up, I mean, you don't treat women like this. You don't treat, you don't treat humans like this, whether they're women or people of color or LGBTQ kids. I saw, you know, an interchange there where, you know, they were, you know, handled really poorly. What's your plan? What's your plan going forward? What are you going to do here to straighten this mess out? You say you're the guy to do it.
Yep.
Tell me about that.
Fundamentally, we got to break the good old boys network that is at the core of the report, protecting each other and providing an obstacle to employees coming forward to report abusive experiences. We have to break that. The report says
Are you going to fire anybody, or have you fired anybody?
We've separated 4 employees this year who've engaged in misconduct, and we have
separated. What's that? Did you fire them, or did you reassign
they either
them?
received termination notices and were fired, or they when they've been informed about disciplinary action, before the disciplinary action takes place, they leave the agency or retire.
How many people have you fired?
4 separated this year.
Sounds like you need to fire more people than that. I'm just reading
Well-
this record. 4 people didn't do all this. A lot of people did this.
I agree with that.
Go ahead.
I agree with that.
Go ahead. What else?
So we need, as the report recommends, fundamental structural change to break the network, which is why we are proposing setting up a new independent office outside of the organizational structure of the agency, where we would consolidate all of the misconduct responsibilities for the reporting of complaints, for the investigation of complaints, utilizing independent third parties to do investigations, and for disciplining misconduct when it occurs.
All right, look.
And it would report directly to the board of directors.
All right. Okay, so we need to be informed. We need reports every couple of weeks on who you're firing and what the changes that you made. You're on a short leash.
Understood.
You know, there are a lot of people here who'd like to see you gone, to be honest with you. And you know, I'm not so sure you're the guy to make the changes, but maybe you are. Maybe you can prove that to us. I don't know. It'll take some doing. But things have to change there. Mr. Sue, I would like to talk about financial services at some point here. Tokenization. I know you just had a symposium on that. I'm the ranking Democrat on digital currencies, and I'm just I'm just concerned about. I have a question. Is it possible to tokenize any security?
So it depends on how that term is being used. And I think we have to be very, very careful.
Which term? So tokenization or security?
No, tokenization.
Okay.
Some people are using that term very loosely, and I would caution against that. Because for tokenization to solve the underlying problem of settlement, it has to be fully aligned with the legal system. So you have to solve not just the technological problem, you have to solve the underlying who owns it, how do you transfer ownership, how do you risk management? And that is the right way to approach it. That's a symposium that we held, was to tackle all of those questions. There are folks out there talking about tokenization who are only talking about the technology layer, and that's half of it.
Okay, my fear is that the tokenization issue, the technological part of it, could upend, could turn the traditional security system upside down. Is that a legitimate fear?
So that is a possibility if it's not done correctly.
Okay, all right. Thank you. Mr. Chairman, I yield back. Thank you.
Gentleman from Texas, Mr. Williams, is recognized for 5 minutes.
Thank you, Chairman. And before I begin with my questions, Mr. Grunberg, I'd like to state for the record that I strongly condemn your actions exposed in the recent report. Many of my colleagues have touched on this today, but this 234-page investigation detailed a very toxic environment within your agency, and I'm a small business owner. I know how that can hurt a business. And your actions and the actions of the individuals involved are unacceptable, and I will not be, and we don't tolerate that. Next, I'd like to follow up a little bit on what Ms. Wagner said, and how are we, sir, supposed to believe you're willing or even able to implement a culture change if you can't accept responsibility for your own actions? We've heard that you took a tour to a regional office for listening sessions. Well, it's safe to say that didn't go well either. And I've been told that one of these listening sessions, an employee asked you directly who their allies are and asked you directly, who is my ally? And you responded, I've got to get back to you. Well, if that answer is too complicated for you, I think you're the wrong person to lead this change. And you'll get back to them. The answer here was pretty easy. It's me. I'm your ally. You're the chairman of this agency, which with a total workforce of over thousands of employees. And at the very least, these employees should feel like you are their ally. Now, that being said, let me move on to Chairman Barr. I would like to begin by discussing the long-term debt proposal. The proposal would require a covered bank to hold debt equal to at least 6% of its risk-weighted assets. This amount, 6%, is far too high for regional banks given their risk profile. This will increase these banks' costs, and these increased costs will be inevitably passed down to consumers like me, a small business owner, without strengthening financial stability. Imposing such stringent requirements on regional banks not only stifles their ability to lend to small businesses and stimulate local economies, but also undermines the fundamental principles of free market capitalism, which hinders competition and innovation within the financial sector. So, Vice Chair, how do you see the standardized 6% impacting smaller banks? And do you think there is a value in tailoring the percentage required based on the size of the financial institution?
Thank you, Congressman Williams. It's a really critically important question. We are looking very much at the question of what the right calibration is for different size of institution. We received a lot of comments on that question. We're taking those very seriously. We want to have a requirement that improves the resiliency of the financial system and that also respects the diversity of our financial system, which is really a critical goal.
Thank you for that. And I have serious concerns about how the Basel III Endgame proposal is going to negatively impact small businesses and the institutions that serve them and provide for small businesses' individual needs. I still don't see why we can't do it the American way, why they can't follow America. And this proposal will severely reduce financing and access to capital for small businesses, making it harder for them to secure funding to hire workers, maintain operations, and expand their operations. This could result in a domino effect, stifling economic growth in local communities where these banks are often a driver of entrepreneurship, and businesses like mine, we go to community and local banks. As a consequence, the proposal risks hampering innovation and job creation. Businesses across this country are struggling to navigate this regulatory landscape and, quite frankly, handle the increase in burdensome requirements. So, Comptroller Sue, has the OCC held discussions regarding the Basel III proposal with small businesses? And how have you taken businesses' concerns into account?
Thank you for the question. So we've received quite a few comments from small businesses and those interested, expressing the interest of small businesses. And those comments we've taken those all into account as part of the process, as my colleagues have pointed out. We're taking it very seriously. We're looking very closely at those.
Okay, very good. With that in mind, I yield my time back.
Gentleman yields his time. We'll now recognize the gentleman from California, Mr. Vargas, for 5 minutes.
Thank you very much, Mr. Chairman. I do apologize at the outset for my voice. I'm starting to lose it. I know it's a bad thing for a politician, but it happens. I was excited today, some time ago, to talk about oversight of the Prudential regulations, and regulators, I should say, and I was very anxious to talk about Basel III, the endgame. I was a signatory to the letter that was sent to you. I do have some great concerns. And I also want to talk about something I'm very aware of, and that is the climate-related risks, the financial risks that the system faces, and I wanted to talk about that. I think it's very important. However, obviously, we've delved into what is happening in FDC, and I think it is important. I would associate myself with everything that my good friend Jim said, the fine member from Connecticut. I have 2 daughters, too, and I love them more than life itself. And to think that they would be in an organization where they would be harassed and that they would have no recourse and there would be little care for them outrages me, just outrages me as a father, as a human being. I think it's outrageous. What went wrong? I mean, your department seems to be an outlier. What went wrong?
I think this is a long-term issue, Congressman. As the report indicates, I think it was particularly challenging in our field offices around the country. The FDIC supervises nearly 3,000 banks. We have 70 field offices, often in remote locations, and that presents opportunities for misconduct and challenges for oversight and supervision. And that has to be a focus of our attention.
Just to be fair, I was a vice president at Liberty Mutual. A lot of offices all over the place, too. But there was a culture that you didn't put up with this crap. You just didn't, and you have an avenue to talk to somebody and ultimately get to people like myself. I was in the corporate legal side, and we would do something about it. And that's why, to me, it's not, I don't understand how this could have happened for so long.
I think that's the issue we have to address. This report that's come out has given us a deep line of sight into it, and we're going to work to address it and to fix it. That is the commitment we've made.
Okay. I do also have some
some serious doubt of your ability to do it because you've been tangled up in this. Your temperament and other things that came out in the report. You were going to say something. I'm going to allow you to say that since I did say something.
Sure, no, only to say I take responsibility for that. I have committed to address it and to accept the recommendations of the report in regard to it. We have been working on this for a number of months now. We are making progress. This new report gives us additional information, and we will address this
I still
issue.
have some doubts, but I'll give you some time. Mr. Sue, you've been dragged into this a bit. And in fact, at one point, you pointed to a gentleman in the audience. I believe he's probably your attorney. Could you point to your attorney? I believe at one point he asked you not to answer a question because of some reason. Is that correct?
So I want to be as open and honest with Congress as possible. I also want to follow the law.
That's right.
And so there are laws related to Privacy Act and others where I just want to make sure I follow that. That's why I consulted with him.
I knew that, and that's why I asked you. I'm an attorney myself, and that's why I don't want you to get dragged in unnecessarily. Now, there is some responsibility, though, on you, too. And I want you to make sure that you take that very, very seriously, especially sexual harassment, discrimination. Shouldn't happen. I mean, I look over there at Vice Chair Barr, you know, and I have to say, I have full confidence in him. I know we've had issues here on other things, but I have full confidence in him. I know his background, and I expect if he had this in his organization, he'd do something about it. I hope you have the same attitude as him. Mr. Barr, I don't have any questions for you now other than, again, I do want to talk later on about the end game. I do think that it makes it more difficult for people who are first-time home buyers to be able to qualify for a mortgage. That's a big deal to me. We'll talk later, obviously, about the risks of climate change. It's a big deal to me, but I did want to talk about this. I'm a parent, too, and I think this is an issue that has to be resolved. Thank you.
Gentleman from Georgia, Mr. Loudermilk, is now recognized for 5 minutes.
Well, thank you, Mr. Chairman, and thank you all for being here today and representing your respective agencies. It's difficult to have this conversation today, Mr. Grunberg. But one thing I've noticed, it's troubling to me beyond just this report, and we'll get into the report, is one of the things that our local banks, especially smaller banks, tell me is that at one time, they felt the FDIC and other agencies were partners with them to help them navigate and make sure that they're compliant with regulation, the regulations made sense, and that both parties worked in the best interest of their customers. They no longer feel that way. They see the FDIC as an adversary, that they're hesitant to ask for advice because, and this is across the board with a lot of agencies, is that they see it as a gotcha organization looking for a reason to come after them. And it's especially with smaller financial institutions. And so I think that's a broader issue that we have to address, is that our agencies should not be viewed as adversarial, but as in a partner with institutions. I believe I've been honest in the assessment of the FDIC over the years, both positive and negative. In previous hearings, I've praised some of the informative reports that have come out of the FDIC. However, I must say that I've read the Cleary-Gottlieb report, and I'm disturbed by the evidence that it presents. And Mr. Grunberg, in the Cleary report, you're quoted as having said that you did not recall specific instances where you were accused of raising your voice, losing your temper, or throwing objects. In your interviews with committee staff, you went a step further and said that you have never yelled at an employee or lost your temper. In fact, you placed the blame on others for misinterpreting your tone and body language. The Cleary report also noted that you have been unwilling to accept that others have experienced difficult interactions with you. The Cleary report draws on examples of inappropriate conduct dating back to 2007, nearly 20 years ago. You failed to accept responsibility for your behavior for nearly 20 years and only did so reluctantly after public scrutiny. From my perspective, it seems like you had no fear of being held accountable until you were. With these revelations, why should Congress, the public, and your staff trust that you will do better in the future?
Thank you, Congressman. As I indicated earlier, I accept the findings of the report. I'm committed personally to addressing them. I'm committed to implementing the recommendations made, specifically in regard to me and our executives in the report, including having so-called 360 reviews done each year. I understand that employees have experienced my temperament in a way that was disturbing to them. I accept that. That's all that matters. It doesn't matter what my perception is. It matters what their perception is, and I'm committed to addressing that.
Well, I appreciate that. It seems like maybe that commitment is about 20 years past due, and I think that's the concern that we're having here. The Cleary report also noted that in a 9-year period, 92 complaints were filed, and only 2 of those complaints resulted in a suspension from the agency. So how can FDIC employees expect their harassers to be held accountable when their leader is not held accountable for his own appropriate behavior?
If I may just add context to that, Congressman, I'm not challenging the information in the report, but just to add context, during the period cited there, 2015 to 23, there were actually 18 employees separated from the agency, which means they received notices of termination or other disciplinary action. They either left the agency because of termination or in anticipation of disciplinary action, they left or retired, which they have the ability to do. But there were actually 18 individuals separated from the agency during that time.
Well, I believe, based on this report, that the hostile work environment at the FDIC is directly related to an inability to take responsibility as a leader. You failed to uphold the integrity of your office by doing the right thing even when no one was watching. Now everyone's watching, and unfortunately I have no choice but to join in with some of my colleagues in asking for your resignation. With that, I yield back.
The gentleman from Illinois, Mr. Caston, is recognized for 5 minutes.
Thank you, Mr. McHenry. Thanks to all our witnesses here for a long day. This will surprise all of you. I want to talk about climate finance. Before I do that, though, I don't want to pile on. There's little that, what's the old saying? There's not much that hasn't been said, but I haven't said it. I share the deep concern of all my colleagues with what happened at the FDIC and the culture that allowed that to happen. I also, as a guy who spent 16 years as a CEO, have sympathy for the loneliness of the corner office, if you will, and how heavy weighs that crown and the responsibility. I also just want to caution all of us on this panel that when we say corporate America would never allow this, they would terminate the leader, this is not corporate America. Those of us on this side of the dais do not have hiring or firing authority with respect to this decision. We do not have the ability to change the culture of the organization. We certainly have the ability to make it politically impossible for you to continue. But we won't be held to account if that's the wrong decision. And I don't read that you were the agent of the problems. I didn't see anything there that you have personally harassed or assaulted anybody or certainly not been convicted of such assaults. I think it's an open question whether your removal would solve the problem. But I just would hope that we would all keep in mind that if we are concerned about the culture, let's not confuse a political scalp with changing culture, because finding a new person in that seat is not our job, that's the Senate's, and no one would ever accuse the Senate of being a rapid and effective recruiting and hiring manager. It just makes a vacancy. I want to talk about Basel. Chair Grunberg, the last time you were here, you and I talked about the concern that I had about this 400% increase in risk weighting for tax equity. I think you said at the time that regulators may not have fully appreciated the effect that that would have on clean energy. Given the comments, the discussion since, do you at this point support revising those risk weights down for tax equity?
Thank you for the question, Congressman. This is a proposal that's still out for comment. We have not finalized it, so I can't speak to what we're going to do. Let me simply say we have received a lot of comment. This is an issue that has received a lot of attention by the agencies, I think we understand the concerns that have been raised.
Okay, and Mr. Barr, there was reporting in Bloomberg last week that final Basel rules might be as soon as August. Would you like to comment on that? Can we anticipate that some sense of timing of when we'll get clarity on these issues?
I appreciate the question. As I indicated earlier, the Bloomberg article did not reflect the reality as I know it on the ground. That is, we have not made any decisions about the substance. We're still working our way through that. We've made good progress on that.
Okay.
And after we're done with that, we'll figure out process and timing.
I want to move on, but just the sooner the better. I continue to remain concerned that there are pockets of capital that want to play in the space that are sitting on the sidelines longer than they need to right now, and the sooner we can do that, the better. Vice Chair Barr, I want to talk a little bit more about the climate scenario analysis that was just done for the GSIBs. In the report, you mentioned some of the data challenges that banks had modeling physical risks. Can you speak at all to what those challenges were and what, if anything, we need to do to help to get that data?
Yeah, so the banks are in some ways at an early stage of trying to understand and measure and manage those risks. One important area, for example, is data about insurance coverage.
Mm-hmm.
So some of the institutions for some of their commercial real estate, for example, had some data on insurance coverage, but not full data on that in coverage across their portfolios. And there was a lot of variation across the financial institutions. And of course, the losses that a bank would suffer are related to the availability of that insurance coverage.
Given that insurance issue, I'm sure you saw the story in the New York Times this week about insurers pulling out, property and casualty insurers pulling out, not just on the coast, but in my own state of Illinois because of hurricane or hail risks coming through. And as you go through and look at where climate risk is getting into the financial system, I'm presuming that the banks, once they see the risk, will find a way to offload it. In your view, do you have the statutory authority to chase and follow that risk through the system, or do you think your statutory is limited to saying the GSIBs, the banks, we have the authority to look at, if the risk is gone, we don't have to watch it anymore?
Well, I would say we have supervisory authority over the banking system. We do monitor risk throughout the financial system.
I mean, I guess the concern I have, and I see I'm out of time, I want to make sure that if insurers go away and it's left holding the equity and then it falls to property taxes, it's going to come back on our bailiwick. And if we need more authority or more direction, let's work with you and follow up offline. Yield
The
back.
gentleman from Tennessee, Mr. Rose, is recognized for 5 minutes.
Thank you, Chairman McHenry, and thanks to Ranking Member Waters for holding this hearing, and thank you to our witnesses for being with us today. Chair Grunberg, I know this is not a fun day, but I want to focus on your leadership at the Federal Deposit Insurance Corporation. As the Vice Chairman of the Oversight and Investigation Subcommittee, it is important that we appropriately understand the damaging implications of the independent Cleary report and your conduct. Yes or no, when an FDIC employee has a legitimate complaint about a colleague mistreating them, is there a formal process for them to file a complaint?
Yes.
That's right, yes. And Chairman Grunberg, it is my understanding that the complaint process is that Human Resources work with the FDIC Legal Division to investigate and hold individuals who are accused of being a harasser or bully accountable. Is that correct?
Yes, Congressman.
What happens, though, when you, Chair Grunberg, are the bully or the harasser? And having read the report, I can tell you what happens. Your behavior goes unchecked, sadly. Your victims are too afraid to complain to HR. Some are even too afraid to speak to this committee or Cleary investigators. And with all who have heard your testimony and watched this hearing today, we have heard how you berated a senior executive and made her feel like she was working in a hostile environment. We have heard how your senior staff fear giving you bad news because you scream at employees. Chairwoman McWilliams immediately became aware of the cultural issues you created when she started, but in the 20 years you have spent, 20 years at the FDIC, you have failed to address any of these issues effectively. Your reign of fear and mistreatment at the FDIC must come to an end, sir. I hope all of the members of this committee join me in saying that correcting harassing and bullying behavior in a toxic workplace cannot be successfully carried out, frankly, by the person responsible for creating these issues in the first place, like you have. It has become clear to me that based on today's hearing, my reading of the Cleary report, and how you plan to address these issues by, frankly, handpicking your own so-called third-party monitor, it is clearly time, sir, for you to resign. Chair Grunberg, in terms that I hope you can understand, that I'm sure you can understand, I conclude that your chairmanship is insolvent. Thank you, Mr. Chairman. I yield back.
Will the gentleman yield?
Yes, I yield to the chair.
Mr. Grunberg, you repeatedly say that you have a process to clean up the agency, right? You outlined that in some answers. You've not outlined how you intend to clean up your actions, the subject of this report. Can you speak to that?
Yes, Mr. Chairman. As I indicated, I accept the findings of the report in regard to me. I'm personally committed to addressing the issues identified.
How are you going to address those issues? That's
well,
my
at the end of the day, it seems to me it's a personal effort on my part to address these issues and also to
Describe your effort on your part, the personal piece. Describe that.
I think it's incumbent on me to be more sensitive to how my conduct may be received by employees, and to understand the only thing that matters is not my perception, but their perception.
And how long have you been at the agency?
Since August of 2005.
And how long have you been the leader of the agency, cumulative?
Well, I became acting chairman in July of 2011, became chairman in 2012, served till 2018.
10 years roughly, right?
Approximately.
So how are you going to convince the people that are reporting your behavior, the problems of your behavior, how are you going to convince them that you're not going to treat them like you've treated them for the last decade?
As the report indicates,
No, I'm asking you, not the report. I've read the report. Sure. I'm giving you an opportunity to say you're going to seek anger management counseling. Do you intend to do that?
I'm happy to. I'm certainly.
No. I'm asking what you intend to do. I'm not trying to convince you in a hearing. I want to hear a plan. You've given us no plan on what you, as the head of the agency, are going to do to change your treatment of your direct reports. You've said nothing about that.
The report specifically recommends a 360 review on an annual basis.
I know you're talking about to the agency employees. You've said nothing about what you intend to do about your treatment, which is the subject of most of these questions today. And with that, I understand. You're going to refer to the report again. I don't need to hear that. I wanted to hear a better answer, and this is a very disappointing answer that you've given. I yield back to the gentleman, and the gentleman's time has expired. Thank you, Mr. Rose. I will now recognize the gentlelady from Massachusetts, Ms. Presley, for 5 minutes.
Thank you, Mr. Chair. The work of the FDIC is paramount in supervising our banks, strengthening our financial system, finalizing important regulations like Community Reinvestment Act, Basel III, and in times of economic crisis, FDIC is even more important. It was just last year when folks in my district, the MA 7th, were constantly refreshing the agency's webpage to see if their money was safe after the failure of Silicon Valley Bank. The agency's mission is critical, and there is much work to do. I had initially planned to spend this time discussing regulations and requesting updates from Chair Grunberg on the timeline for finalizing rules that stabilize our financial system. However, after reading the recent report into the FDIC's workplace, the public needs answers on the toxic culture of racial discrimination and misogyny that has taken root and festered at the FDIC. Chair Grunberg, you have failed your staff, people of every walk of life, but especially women employees who have brought their knowledge and their skills to serve at the FDIC, and you have failed the American public who relies on the agency to work productively and to put forth policies that protect consumers from bank malfeasance. Now, I have to just consider the source here when it comes to some of the outrage from my colleagues across the aisle, because these are the same people who seek to actively defund diversity, equity, and inclusion, who denied and undermined the Me Too movement, who voted against the Violence Against Women reauthorization, and who don't want to support finally passing the Equal Rights Amendment. And that is why I am truly disgusted by the fact that you have created an opportunity for Republicans who did all of those things to advance their anti-regulation agenda and to use survivors, which I am one, of abuse as political pawns. Moreover, there is not one woman on this panel, and I almost walked out just on the strength of that. But the only reason why I didn't is because that is a systemic issue here in Congress and often for people who come before this committee. And if you don't have one woman in a position of leadership and authority that should be there, then that is also a problem. But again, women, hundreds of women, the report detailed hundreds of women who experienced harassment with no recourse. For over a decade, the FDIC, under your leadership and your predecessors, ignored them. Chair Gruenberg, in November, in fact, not that long ago, you stated that the FDIC already has, quote, appropriate policies and procedures in place, unquote. Do you now agree, and this is a yes or no question, I'm serious, do you now agree that the policies and procedures in place have been a cataclysmic failure and an affront to the many women who have been harassed, pushed out of the FDIC, and forced to change their career goals and life trajectory?
They have failed, yes, Congresswoman.
Small, ashamed, traumatized, humiliated, alone. These are just a few of the words to describe the intense feelings of sexual harassment and what survivors endure. According to the FDIC's own reporting, more than 80% of harassment complaints resulted in zero discipline. And when there were repercussions, not a single one resulted in removal, reductions in grade or pay, or any discipline more serious than a temporary suspension. I am so tired of white men failing up. This lack of accountability is a shameful, inadequate, and deeply unsatisfactory, and it is re-traumatizing. Chair Gruenberg, can you guarantee right now no employee at the FDIC will face any form of intimidation or retaliation for reporting an incident of sexual harassment regardless of confidentiality agreements?
That's our goal, Congresswoman. Yes, the answer to that is yes.
It is shameful that through your inadequate leadership at the helm of this agency that you have fueled calls for your resignation from the political opportunists across this aisle and jeopardized critical regulations pending finalization at your agency. Personally, I do not have confidence that you can continue to lead in this role because there is a deficit of trust and your credibility has been undermined to lead the FDIC through the changes it needs to make to affirm the dignity of the survivors of harassment, discrimination, and abuse at your agency. Thank you, and I yield.
The gentleman from Ohio, Mr. Davidson, is now recognized for 5 minutes.
I thank the chairman. I'd like to ask unanimous consent to enter the 2018 letter from African-American FDIC employees, a letter that the ranking member also received in 2018, into the record.
Without objection.
Mr. Gruenberg, yes or no, are you aware of a September 2018 letter that Chairman McWilliams received from a group of anonymous African-American employees describing discrimination and a toxic workplace that they had experienced at the FDIC?
Yes, Congressman.
This letter described African-American employees as being, quote, afraid to speak about issues they faced for fear of repercussions because the FDIC's culture and claimed this discrimination had persisted since 2001. How long into your chairmanship did you become aware of this?
The letter you referenced was not shared with me until 2022, Congressman.
What actions have you taken to try to address that culture? Because culture has been bad there, and frankly, presumably that was part of why you were considered the right person for the job. Now, errors in judgment aside, what have you done to actually positively influence the culture there? Because much has been made of the things that you've failed to do, and frankly, some errors and omissions in the past. So what could you say that you've actually done to try to address these concerns that were part of the culture that you were brought in to shape?
That letter raised a number of issues in regard to the opportunities for African-American employees at the FDIC in terms of hiring, retention, promotions. We've had a strategic plan, and it has been a core priority of the FDIC.
I would just say the plan hasn't worked well. So, look, I think I join my colleagues in saying I think that we need new leadership at the FDIC and abroad of our agencies. It's incredibly disappointing to see the culture, and frankly, a culture that doesn't seem like you're the right person. Look, lots of people can find excuses. Leaders find a way, and clearly you haven't found a way to positively influence the culture. If anything, it's gone the opposite direction. So I think it's a real problem for the FDIC. The work of the FDIC is really important, and when you look at the core mission, the FDIC really hasn't done well as a regulator. When I look broadly at the three regulators that are here today, there have been a lot of problems in the regulatory space. If you look at Silicon Valley Bank, we had a failure of the San Francisco Fed, we had a failure at the FDIC, and clearly a failure of fiduciary duty by the board and the leadership of Silicon Valley Bank. So when I look at the role of Congress in this, maybe the biggest void is with the Fed, because at least we can say that the FDIC and very clearly the OCC have more control with appropriations. A lot of you have a lot of autonomy to the point where we see things like Operation Choke Point, I don't know whether it's 2.0 or 6.0, but the idea that the federal regulators aren't going after things that are illegal, but things that are just disfavored. So, Vice Chairman Barr, one of the actions recently is this idea that we're going to designate new things, systemically important financial institutions, non-bank mortgage lenders. Were you part of any of those discussions with Secretary Yellen?
Congressman, the Financial Stability Oversight report did not recommend designation as an answer to the problems raised in the report.
So Chair Yellen, who is a woman, I'll point out to my colleague, the leader of Treasury, is she free range on this? Is that something that you support, that you really believe we should expand the number of SIFIs? Is that supported, or is that kind of, she's kind of out there on her own on that?
I have a practice, sir, of not commenting on other public officials. As I said, the FSOC report itself is focused on a set of measures that are designed to improve the resilience of the non-bank mortgage servicer sector. The report did not suggest that designation was one of those measures at this time.
Thank you for that clarification. And Director Sue, I'm really concerned about the OCC's role in approving bank mergers. I mean, one of the things that we tried to do with tailoring was to be able to go after appropriate size, fit for size regulation. Part of the challenge is when you look at the biggest banks, there's a wide range between the very biggest banks and the next tier. How do you see merger and acquisitions appropriately proceeding in that environment? Because we've essentially artificially capped the ability for the market to function for these banks.
Yeah, there's no artificial cap. A merger application that fulfills all the statutory factors, being pro-competitive, pro-financial stability, pro-convenience and needs of the community, will be approved. The question is, what kind of merger comes in, and how are all those issues being analyzed, and how do they stack up?
We hope that resolves favorably, and I look forward to working with you. Thank you for your time and testimony. I yield back.
The gentlewoman from Texas, Ms. Garcia, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you for their witnesses and their time and attention today. It's always good to see you all. Let me begin with you, Chair Grunberg. The Clery report discussed the 15 recommendations included in the 2020 Inspector General report on sexual harassment. That's a 2020 report. A year later, in 2021, the Inspector General reported that the same recommendations were closed and addressed. Now, in that Inspector General report, some of those recommendations were about this very topic of sexual harassment and workplace environment, were they not?
Yes, that was the subject of the report.
That was the subject of the report.
Yes.
So we went through all that in 2020 up to 2021. Were you chair then?
No, Congresswoman.
Who was the chair then?
I believe Yelena McWilliams.
I'm sorry?
Yelena McWilliams.
Ms. McWilliams. So presumably, if there was a culture and there was recommendations made, the Inspector General felt like they'd been taken care of and it got closed. Is that an assumption that can be made?
they found that the agency's response to the recommendations was satisfactory from the IG staff.
Well, I'm trying to reconcile that with the fact that in page 88 of the report, it says that the allegations covered the period from the 1980s. 1980s. That's way before the 2020 Inspector General report and way before today. Is that true?
Yes, Congresswoman.
So this culture has been going on for a long time, and apparently the steps taken under the leadership of then Chair McWilliams were either inadequate or the review was inadequate. I'm just trying to reconcile what's really happened in terms of timeline. Now, the hotline itself, I didn't get any detail as to, when the incidents occurred, but they talked about sexual assault, unwanted advances, harassment, gender or sexually based discrimination, workplace bullying, threats. I mean, it goes into a lot of detail over a lot of allegations. So it just really kind of stuns me that something could have been going on since the 1980s, but an Inspector General may have closed the file in 2021, but now we have all these things, okay? And when I look at the history, you all have had probably since the 80s, maybe 12 or 15 different chairmen. You've been acting chairman a couple of times. You're chairman now. When was it that you first really heard, and I don't mean news reports, I don't mean Inspector General, but you personally hear, see, or even feel anything that was inappropriate?
Congresswoman, in terms of the deep-seated workplace culture issues, it was the reports, the news reports that came out last year that identified them in a way.
So from 2021, when the Inspector General closed the report, till last year, you had heard zero.
Yes, the 2020 IG report identified shortcomings in policies and procedures and training by the agency. It made generalizations about workplace culture, but did not make the kind of findings that you saw in the news reports last year.
Right. Did your board have a committee that dealt with this at all during this time period? I'm not talking about the new one that you're creating, but the board itself, did you have a committee that dealt with, human resources, personnel, personal conduct?
Not a committee devoted to that. That would have been a board responsibility and the management responsibility for the chairman.
Right. Well, I'm just trying to make sense of this. Number one, it's totally disappointing, totally unacceptable. I'm just not even sure sometimes how something like this could have existed for so long under so many administrations, if we're talking about since the 1980s, and through so many chairmanships. But the bottom line is, you're there now. You take full responsibility.
I do.
You will implement all these programs.
I will.
Will you enter in some type of self-improvement program, as the chairman has suggested?
Yes.
And what might that include?
I think that's something we'd have to develop, but certainly coaching or counseling, as well as a 360 review recommended in the report.
No, I'm talking about you yourself, sir.
Yeah, I think it's fundamentally a issue for me to address in terms of my personal interactions with staff and be more sensitive to how staff receive interactions with me and ensure that they're appropriate. And the only thing that matters.
Will you take an anger management course?
Yes.
Okay, thank you. I yield back.
The gentleman's time's expired. I don't recognize myself for 5 minutes. Mr. Grunberg, do you know who Eric Lander is?
No, I'm not familiar with
He's
that.
the former director of the Office of Science and Technology Policy. Do you know who Martin Dickman is?
No, sir.
Dickman was the Inspector General for the United States Railroad Retirement Board. If you don't know who either of these are, you may not know what they have in common. Both were either fired or resigned for mistreating their staff. Mr. Lander resigned in February of 2022 after reports surfaced that he bullied and mistreated subordinates. Mr. Dickman was subject to an investigation like the one the FDIC just underwent. That investigation found that he created a, quote, toxic work environment and engaged in abusive treatment, end quote. Mr. Biden fired him 2 months ago. You probably remember that on the day before his inauguration, President Biden laid out a zero-tolerance policy for this kind of behavior. Here's a direct quote from President Biden, quote, if you ever work with me, and I hear that you treat another colleague with disrespect or talk down to someone, I will fire you on the spot, no ifs, ands, or buts, end quote. So these two men lost their jobs for crossing the line set out by President Biden, but you're still here, even though a thorough review has found that you've done some of the same things. To be honest, I think it's transparent what's happening here. The administration can't afford to lose you, in particular, your vote on the board, which is key to getting the Basel III endgame done and engaging in an aggressive political agenda. Let me shift gears and dig into the report briefly here. In the report, it found that you are aggressive. Do you dispute the findings?
I accept the findings, Congressman.
And so you accept that you are aggressive to your staff?
I accept the findings of the report, I do.
And so you also accept that you are harsh to your staff?
I accept the findings of the report, yes.
Then you accept that you are vitriolic to your staff?
I accept the findings of the report, Congressman.
And you accept that you are disrespectful to your staff?
I accept the findings of the report as you indicate.
Because I think it's important, some of the language that I've heard you use is that people observe you in this way. The report actually finds that you are those terms. And I think there's a big distinction here, because it's not in the eye of the beholder, as sometimes your terminology has indicated. It is the report found that you have been aggressive, harsh, vitriolic, and disrespectful to your staff. I think that is why I and others have zero faith in your ability to be an effective leader of the agency and have called for your resignation. Let me shift gears and talk about what the agency is doing, the FDIC, under your work. And I want to talk specifically about the role the FDIC should be playing in innovation and the role that it is playing in innovation. Over the last few years, innovative businesses have begun to change the way we bank, and for the better. Yet I've continued to receive complaints about seemingly arbitrary enforcement actions. And I've heard stories from FDIC staff refusing to provide feedback to fintechs on regulatory questions. It's gotten so bad that Vice Chair Travis Hill has said publicly that the perception you've created is the FDIC is, quote, closed for business. So what are you doing to counter this perception? In what we have seen is an aggressive enforcement action as it relates to fintechs. You went from 1 enforcement in 2021 to 14 in 2023. Is that correct?
I'd have to check the record on that, Congressman. I don't know offhand.
Well, I'll tell you that it is. And do you think that you have an aggressive enforcement action preventing innovation in the fintech space?
I don't think so, Congressman.
And so you'd think that is there a reason for the dramatic increase in the number of enforcements?
I'd look into the record. I would say most banks manage third-party relationships, including with fintechs, effectively and well, and they offer useful business opportunities for both. We have had some instances in which those relationships were not managed well by banks, in which they overreached and had significant risk management and consumer protection issues.
And so, what are you doing with the third parties and partnering with financial institutions in meeting compliance obligations before an enforcement action is brought against the banks?
We engage with both parties. As I say, in most instances, banks manage those relationships well. In some instances...
So you would disagree with those that say you have a hostile stance toward fintech's partner banks?
Yes.
Very nice. I yield back. I now recognize Mr. Torres for 5 minutes for the purpose of asking questions.
Thank you, Chair. Mr. Grunberg, I appreciated your leadership during signature. There were 80,000 units of affordable housing that were at risk of losing their affordability, and I felt like you were instrumental in preserving the affordability of those units. But I'm deeply troubled by the findings of sexual harassment, racial discrimination at the FDIC. And so I've been struggling to figure out how I should respond. And I'm curious, imagine for a moment our roles were reversed. Imagine if you were a congressman on the House Financial Services Committee and I was the chair of the FDIC under the cloud of a scandal. would you call on me to resign?
No, Congressman.
And so imagine if you were a congressman from the Bronx and one of your constituents approached you, and you know the Bronx well, you were an organizer in the Bronx, and one of your Bronx residents approached you and said, Congressman, why are you not calling for the resignation of an FDIC chair whose agency has been found to have a pattern of sexual harassment and racial discrimination? What do I tell that constituent?
I tell him this is a serious problem. The chairman has recognized it, taken responsibility for it, and is working hard and has been working hard since last year to address it. And I think it's important to give him a chance to do that. And interrupting leadership at this point would not advance that objective.
And the problem at issue predates you?
It does, Congressman.
Okay, so it's neither a Democratic nor a Republican issue.
I think that's true.
Right? It's so systemic that it transcends party affiliation.
I think that's true.
I want to ask about Basel III, Vice Chair Barr. On March 6, 2024, I asked Fed Chair Jerome Powell the following question. How do you reconcile the Fed's repeat reassurances about a well-capitalized banking system with Basel III's assumption of an undercapitalized banking system? And the Fed chair replied with the following answer, quote, I have said for years in this room that I thought the level of capital in the U.S. banking system is about right. And so, Vice Chair Barr, do you agree with Chair Powell that the level of capital in the U.S. banking system is about right?
Thank you, Congressman. I very much appreciate the question. As you've heard me say before, and you've heard Chair Powell say before, I'm not in the business of commenting on other public officials' comments. I will say, from my perspective, overall, the banking system is sound and resilient. The capital proposal that we put forward is designed to correct particular weaknesses in the approach that we have right now.
I want to interrupt for a moment. Setting aside Chair Powell, do you agree with the assessment that the level of capital in the U.S. banking system is about right? Set aside the source of the quote.
Yeah, again, I'm not going to comment on that. I will say that with respect to capital in the system, I think the system overall is sound. I'm not worried about risks in the banking system beyond those that I've identified, but I do think we can do better. And the Basel III approach is about doing better for that.
So when setting capital requirements, there's a trade-off between safety and soundness on the one hand and capital formation on the other. Right? The best regulatory outcome lies not in maximizing safety and soundness to the exclusion of capital formation, nor does it lie in maximizing capital formation to the exclusion of safety and soundness. The best outcome lies in striking an optimal balance between the two. And if you as a banking regulator get the balancing act wrong, as you may well be doing with Basel III, it could mean less credit for households and businesses, it could mean less financing for clean energy. In an age of catastrophic climate change, it could mean less equity and debt financing for affordable housing at a time when housing costs are a disproportionate driver of inflation. Simply put, the loss of credit is no abstraction. And so can you state with certainty to the public that your Basel III proposal has objectively identified the optimal level of capital in the banking system?
Congressman, I don't think anyone can say that on either side of it. The risk of doing too little in this space is that we have another devastating financial crisis that shutters American businesses and harms American households. What we're trying to do is get that balance right.
No one disputes the need for safety and soundness, but you can make that, you could increase capital requirements by 50% on the basis of safety and soundness and in the service of preventing a financial crisis, right? The question is, how do we know with certainty whether we're optimizing the level of safety and soundness and capital formation?
I don't think either of us are in the business of certainty, sir.
Okay. Well, I see my time's about to expire, so.
Thank you. I now recognize myself for 5 minutes. Thank you, Mr. Chairman, and thank you to the witnesses for being here today. Vice Chair Barr, I'm becoming increasingly concerned about rising rates of check fraud, particularly duplicate presentment fraud, which occurs when fraudsters make multiple deposits of the same check. According to recent testimony from the ABA, check fraud has become one of the fastest growing categories of fraud across the country. Duplicate presentment fraud has posed exceptional challenges in recent years, comprising over 1/4 of all check adjustments handled by the Federal Reserve in 2022. I feel like technology should solve this problem. So, Mr. Barr, would the Fed consider operationalizing the Fed's duplicate check notifier service, or explore other technological solutions that can enable real-time fraud detection across all check processing organizations?
Thank you for the question. I agree that check fraud is a significant problem. It's one that we're quite focused on. We are looking at various technological ways that we can help, but also working with banks as supervisors throughout the system. It's an issue that when I travel around the country, community bankers often raise to me. Really, banks of every size are concerned about this.
Is this something that you think technology can play a role in solving or at least reducing substantially?
Technology might help. It's not the only answer, but there are technologies we're thinking about that can help in this space, some of which are being deployed in the banking system today.
Thank you. Chair Grunberg, it is made clear in the long-term debt proposal that the specific calibrations of the rule were determined using the current capital framework that the Basel III Endgame seeks to amend, making an accurate assessment of the long-term debt proposal impossible. It seems premature to finalize the long-term debt rules without fully understanding the impacts of Basel III Endgame. So while I continue to believe that Basel III Endgame proposed rules should be withdrawn and reissued, would you agree that the agencies should not finalize the long-term debt proposal until banks have a better understanding of the capital requirements they will face under Basel III?
The long-term debt rule was really developed, if I may say, Congressman, independently of the Basel capital rule. It's really designed to create a buffer of long-term debt for institutions over $100 billion that could absorb losses in the event of stress and avoid a failure of the institution or reduce the cost of failure. So it's certainly fair to take into account capital requirements, but I think the debt requirement here really stands separate from that.
Would you say that it's unreasonable for this to be implemented if you don't actually know what the result's going to be?
I think we have received extensive comment. I think we have an understanding of what the impact would be. We have not finalized the rule. We're still considering the comments received. But I would not link the long-term debt rule per se with the Basel capital rule.
Thank you for that. I've been in Congress for 5.5, almost 6 years now, and I haven't seen the bipartisan calls for anyone's resignation to the extent that I've seen yours. You don't seem to be intending to resign. What are you going to do to change the culture issues that are present at the FDIC?
The agency has a fundamental challenge. We've been working on them since last year. Fundamentally, we have to break the current culture of a good old boys network that is obstructing proper complaints and accountability for misconduct. And I believe the agency has the ability to do that. As a starting point, we would implement a new independent office reporting directly to the board that would consolidate all of the functions of reporting, investigating, and holding people accountable for misconduct. And then we have a challenge in addition to our decentralized structure of field offices around the country. We have to impose closer oversight and accountability there. If we can do those two things, I believe we can significantly impact the deep-seated issues that have been identified.
If there's this culture problem, I'm sure that there's ways to have metrics associated with it. You can send out surveys and whatnot. At what point, let's say 6 months from now, 12 months from now, if things have not substantially improved, will you reconsider the calls for you to change leadership?
What we intend to do, and it's part of our action plan, is to monitor carefully the implementation of the recommendations and their impact. We have already begun the process of identifying an independent monitor who would audit the implementation of the recommendations and engage an expert third party to advise us on addressing the culture change issues. These were both recommendations of the recent report.
My time's expired. I yield back, and I now recognize the gentlewoman from New York, Ms. Velasquez.
Thank you, Mr. Chairman. Vice Chair Barr, why did the Fed not move forward with an NPRM on Section 956 last week?
Thank you, Congresswoman. We are committed to finalizing a joint rule on Section 956. After discussion with my board colleagues, we decided that it would be appropriate to have additional analysis done within the Fed, and we are conducting that analysis at this time.
Do you support the need for this rulemaking?
I am committed to it, Congresswoman.
And when do you expect for this rule, for the Fed to join the other
Yes, I
regulators?
don't, unfortunately, I don't have an answer to that. I am consulting with my board colleagues on the substance of it.
Okay, and can you explain the problem we are trying to solve under Section 956?
Yes, Section 956 is designed to address problems with respect to executive compensation that can lead to excessive risk-taking at banks.
Right.
That ends up causing serious harm to the country.
We shouldn't wait for another Silicon Valley.
I agree. Silicon Valley was in part a problem of executive compensation that was not well aligned with risk-taking.
And you remember or you recall that this rulemaking was required to be done in April of 2011.
Yes, that's correct.
All right. Okay, thank you. Mr. Grunberg, today's hearing should be an opportunity to discuss the very pressing challenges facing our prudential regulators and the economy as a whole. But unfortunately, the working environment described in the Cleary Gottlieb report paints a disturbing picture. This includes allegations of sexual assault and harassment, gender discrimination, workplace bullying, and racial discrimination. And these were not isolated incidents. The report makes clear that these were widespread and long-running. Mr. Grunberg, I have spent my entire career fighting against these practices in the workplace and in all areas of life. No employee, as I mentioned to you yesterday, should have to work in an environment like this. Yet, this was the reality for more than 500 staffers who were demeaned as they attempted to serve their country through their work. Simply put, the issues outlined in this report must be addressed, and they must be addressed now. And to be frank, I am not satisfied by the answers, Chairman, you have given about how you plan to ensure that no FDIC employee has to go through something similar. The culture of any organization starts at the top. I don't tolerate this in my office, yet this horrid working environment has persisted at the FDIC, where you served as head for 10 of the last 13 years. As leaders, it's on us to protect our employees and have zero tolerance for this type of behavior. For decades, the FDIC has failed in this basic responsibility. I am seriously questioning my confidence in your ability to change the culture of the FDIC and lead the agency moving forward. Mr. Chairman, I yield back.
Gentlelady yields back. We'll now go to the gentleman from South Carolina, Mr. Norman, for 5 minutes.
Thank all of you for appearing today. Mr. Hu, Michael, would you comment on the fact that September of 2022, political activists lobbied the International Organization for Standardization to adopt a merchant category code to track the sale of firearms and ammunition with the stated goal of facilitating and monitoring and reporting of constitutionally protected activities. The goal was to enable government entities to discriminate against both these lawful businesses and their customers, despite the fact individuals have passed a background check. I was very troubled to learn that the Financial Crimes Enforcement Network was pressuring the financial sector to utilize this category code to flag supposed suspicious transactions. has the Office of the Control of the Currency in any way been involved in the effort to weaponize firearms-specific merchant category codes?
Not to my knowledge, no.
So the agency has not.
Not to my knowledge.
Do you think it's an appropriate role of the federal government to weaponize the financial system and engage in this kind of discrimination against the firearm business?
No.
Do you agree that pressuring the financial sector to reveal the purchasing history of gun owners raises privacy concerns?
So there are concerns. Our role is to ensure the safety and soundness and fairness of the banking system. That's our focus. We do not believe that the banking system should, target particular industries. It has to have a risk basis.
So, okay, I'm glad to hear that. I'm in the real estate business. The coming tsunami is in the office space. The default on loans is going to affect this whole country, not just from COVID, but other things as well. The Republicans have been sounding the alarm about the regulatory tsunami that's going to overwhelm the banking industry. And they've been asked to implement the new Capital 1071, the late fee issue, the CRA rules, as well as other guidance documents issued by the CFPB, which they're not guidance, they're vague, and a lot of them mandatory when they used to be. Shall has been the word used instead of option, I guess. Are your agencies considering the impact on banks, and this is for any of you, particularly community banks, on implementing all of these regulations and guidance documents that have been published over the last 12 months? Mr. Barr, you want to start off?
I do think it's important for banks and supervisors to focus on risks to the safety and soundness of the banking system. Like you, we have seen issues in the office, commercial real estate space. We're quite focused on making sure that banks have the appropriate risk measurement and management practices in place to address those issues.
Mr. Greenberg?
I agree with what Vice Chairman Barr said. I would suggest that the rulemakings that we've focused on have generally impacted the larger institutions over $100 billion, either for broader financial stability concerns or also specifically responding to the vulnerabilities identified in the bank failures last year. And I would say in regard to the CRA rule, we were particularly sensitive and responsive to actually lightening regulatory burden for the majority of community banks in the United States.
Any comment?
So I agree with what my colleague said. In addition, when I meet with community bankers and they raise these issues, I invite them to engage with us to identify which of those regulations would be most burdensome.
Mr. Greenberg, do you agree that the resources like the FDIC believe that the banking sector should be oriented toward profitability and stimulating economic activity rather than unrelated political and social goals? Is it appropriate, in your opinion, for banks to discriminate against lawful commerce such as energy development, mineral extraction, and the firearm industry?
They should not, no, Congressman.
Okay, you agree with that. I've got 23 seconds. Thank each one of you for coming. I yield back, Mr. Chairman.
Gentlelady from Michigan, Ms. Tlaib, is now recognized for 5 minutes.
Thank you, Mr. Chair. Thank you so much, Vice Chair Barr. I think all of us have been eagerly wanting to see 956 being implemented. And I think it's been 13 years. And we already know this wasn't a suggestion or a recommendation. It was required by law. But Vice Chair Barr, did Greg Becker, the Silicon Valley Bank's former president and CEO, did he sit on the San Francisco Fed board before his own bank failed?
Yes, Congresswoman.
Most people are, of course, familiar with the idea of regulatory capture in terms of corruption or the revolving door. These are real issues. Do you agree?
I have not seen issues of corruption in the regulatory structure in my
The
experience.
Federal Reserve System is structured such that bank executives hold positions of significant influence and status, correct, on these boards? That oversee.
the presidents, the board members of the regional reserve banks play no role whatsoever in supervision. They're prohibited by law from doing that. And under the Federal Reserve Act, banks are elected to the board by statute. That's not
Okay,
not
so Vice
something
Chair
that we
Barr,
just decide
In
to
terms of
do.
Fed employees, for instance, working on the proposed rule, how often do they interact with the executive officers from banks?
I'm sorry, I couldn't hear the beginning of the question.
So in terms of the Fed employees, working on proposed rule, do they often interact with the executive officers from banks? Because, they're on these Federal Reserve banks.
Senior staff at the Federal Reserve do receive comment from the banking sector at staff of all different kinds of levels. Usually the more senior staff or executive as an organization would meet with me.
I'm just trying to figure out why it took 13 years. So in terms of Federal Reserve Board of Governors, for instance, to what extent do members' social networks overlap with those bank executives?
I don't know the answer to that question.
Are financial executives commonly part of members' social circles?
I don't know.
So how often do members of Board of Governors of Federal Reserve interact with bank executives at work or personal capacity?
That work what?
How often do members of the Board of Governors of the Federal Reserve System interact with bank executives at their workplace?
I often meet with bank executives. It's part of my job. I engage with them as a supervisor and also receive comments from them on our regulatory process. Other members of the board also regularly
It's just that
interact
they might
with
come, and again, this is really me trying to figure out what is going on. Why 13 years? So this might come, I don't know, because regulators identify with those that they regulate sharing overlapping social networks or simply perceive finance executives to have a high intellectual, economic status. I mean, I'm just trying to figure out if it's all within this circle and folks are just, making decisions based on their social networks, not based on what is required by law.
My experience at the board over the last nearly 2 years is that board members are trying to do their best to reach a substantive judgment based on their own
So
understanding.
it's going to take
of-
13 years every single time to enforce the law.
I can't speak to the 13 years. I'm just
long
describing my
I
experience.
know, Vice Chair Barr, I believe you that you have intention of implementing. I just hope it's soon. Is it going to be 2 months, 3 months, 4 months before we see actual implementation of Section 956?
Again, I can't commit to a timing. I'm doing my best to work with my board to resolve these issues in a way that is meeting the congressional statutory requirement.
Chair, we've spoken, and you know that I'm a survivor myself. My first job outside of college, you know this. I read and I tried not to, but I needed to see how, I saw the numbers, I saw the incidents, but one FDIC employee reported to them that she feared for her own physical safety after a more senior colleague who had been stalking her continued to text her even after she made a complaint against him for, among other things, sending unwelcome sexualized text messages that feature partially naked women engaging in sexual acts. My God, like that, there's more. There's more, Chairman. I told you this, when it happened to me and I told people, they weren't surprised. I lasted 5 months because no one did anything. And Chairman, I say this from my deep, you understand there's no trust right now. Many of the people that have been impacted directly from the lack of action, lack of accountability, in this sense, like, well, I didn't know, I didn't get it until then. It's a long list. We're not talking about 10, 20, 30 people. Over 500 people call that hotline. Some of it's even on religious discrimination, on just all these other things. But I know as a woman in the workplace, it's that power they put on you, the way that one of them even lured her away to rub on her. Chairman, this is incredibly serious. So I just want you to know I don't know how you do it. I don't know how you build trust among the people that are now relying on you to make sure it never happens again. And I don't know how we heal or address the trauma and really the culture that has been created within within, just the whole feds. I mean, this is pretty unbelievable. Thank you, Mr. Chair.
The gentleman from Pennsylvania, Mr. Muser is recognized for 5 minutes.
Thank you, Mr. Chairman. Vice Chair Barr, good afternoon. The QIS, you had stated earlier that would be released, I believe you said very soon. Can we get a better idea of when it will be released than that?
I don't have a precise timetable. I said relatively soon. I think it will be relatively soon. As I indicated, the staff have gone through a process of cleaning the data, and they're doing quality control.
Right.
When they're done with that, we will release it.
6 weeks?
Again, I don't want to specify beyond what I've said, which is relatively soon.
Okay. So let me ask you this then. In light of the continued inflation and increasing unemployment and housing issues and commercial real estate effects on banks and rental prices going through the roof and credit card debt of consumers at the highest levels, I think, in recorded history, interest rates going to stay at higher levels. I mean, they're not going to come down with continued inflation and all, and CPI numbers and everything else. Access to capital for small businesses is already very much of a challenge. There's minimal capital investment taking place within small businesses and large businesses. So the economy's on very thin ice. And why would you want to, with Basel III, is where I'm going with this, put more weight on that ice at a time when things haven't improved, where I guess anyway that you haven't estimated they would be at this point? My understanding is that Fed probably understood inflation would be almost under control, or at least better than it is right now, and the economy would be a little bit more stable, unemployment would be going up, but yet that's got to factor in your decision-making on Basel III, the state of the economy and where the economy is likely going to be in the next 3 or 4 months, really not getting better.
Yeah, thank you, Congressman. Let me say a little bit about the economy and a little bit about Basel III. On the economy overall, inflation has come down over the last 2 years from a high of 7.1% to 2.7% on a PCE basis today. We still have more work to do to get it down to 2%. We're cognizant of the way the effect this has on the economy. It's important for us to be able to achieve that lower inflation in order to have stable
But the real
employment.
question is not on the session on the economy, excuse me, but why Basel III with the state of affairs?
And with respect to Basel III, we're not trying to decide whether a capital rule is appropriate for 3 months from now. We're trying to decide over the long term, through the economic cycle, what's the right balance of risk and reward trade-offs in that space. So we're designing for the
factoring into
long.
your decision-making. Can we agree that it's
Pardon me?
the current affairs as they are factoring into your decision-making related to Basel III?
We do not think in the short term about the economy. We think over the long term, what's the right way of judging
All
the
right, so
health
you're
of
going to
the
ignore
economy.
the state of affairs and just continue ahead based upon other things related to Basel III?
We're not at all going to ignore the state of affairs.
Okay, so you're not going to ignore it.
Our job is to really take all the comments in and to assess those
That would
as
be
we're
good.
thinking about
That would be
it.
good. We've talked about this, and that would be good. That's what's very important, particularly from small business, which does most of the employment.
I'm happy to follow up with you.
Great, thanks. Chairman, I wanted to speak to you today about the business payroll, FD deposit insurance, but in light of everything else here, so was anyone fired along the course of this situation at FDIC?
We have had 4 individuals this year.
Did you fire them?
The agency issued a termination notice.
Lawsuits? Is this causing the taxpayer a lot of money in lawsuits? There's got to be lawsuits.
You don't know what recourse individuals may take.
You don't know? I was Secretary of Revenue in Pennsylvania. I knew every instance of any trouble whatsoever. You don't know? And we had 2,500 employees. You got 10,000. That's not that many.
I'm simply indicating these 4 individuals were separated from the agency.
See, that's just unacceptable. I mean, think about it, right? Let me ask you a question. If one of your regional offices, you got a report like this, or rumors or complaints over the last couple of years at one of your regional offices, would that regional director be held responsible by you? Would you fire him? Would you throw him out as quick as you could?
We have had changes in 4 of our regional directors over the past, since those reports came out.
Since the report came out last Thursday?
No, I'm sorry, the news reports last year.
Okay, I yield back, Mr. Chairman. Thank you, Mr. Chairman, I yield back.
Gentleman's time has expired. We'll now go to the gentleman from Wisconsin, Mr. Fitzgerald.
Thank you, Chairman. We're obviously all appalled at the findings of the report into the toxic culture at the FDIC. And quite honestly, I can't believe you're sitting here today before the committee. Thought you would have resigned already. One FDIC employee reported how she feared for her own physical safety. So we're not just talking about the harassment. If you have employees that feel that way, it's far more serious than I think we could even describe here in the short period of time that we've been given. You can't consider the FDIC a good work environment right now for employees, specifically women, do you?
We have a lot of work to do, Congressman.
Would you feel comfortable if your own daughter worked at FDIC?
Yes, and we have many employees who do have daughters working at the FDIC.
Well, I think I join a long line of members of Congress that simply wish that you would resign and turn leadership over to someone who may be more competent and have a better handle on the issues within the FDIC. I have a few questions for some other witnesses. I've been pleased to see that some of my colleagues on the other side of the aisle see the problem with Basel implementation proposal. However, rather than going back to the drawing board, some of my colleagues are pushing only for the narrow carve-out from increased capital requirements for green energy tax credits from the Inflation Reduction Act. I think you likely will say that Mr. Barr, this is directed to you. So I think you would likely see that there's some trade-offs necessary to prevent kind of any financial crisis that doesn't help families likely to obtain a mortgage under the proposal, which is something I've just been personally focused on. However, if such a carve-out is granted to address only one of the many problems in your proposal, while much of it remains intact, what message would that send, not just on the independence of the Federal Reserve, but to families who may have more difficulty getting a mortgage or a small business who would see reduced access to credit? Because I feel like that's really at the heart of a lot of issues that have emerged, is the lack of the ability of kind of this, what we considered a wealth builder, which is home ownership, and small businesses being able to flourish. So I'm wondering if you have any comments about that.
Thank you, Congressman. We take very seriously the comments that we got on the proposal. We expect to make material changes to it, broad changes to it. I will say even the proposal as proposed would have a very, very small effect on the price of credit in the economy, including with respect to mortgages and small business. But we heard those comments very much. We're looking at the prospect of making changes on all 3 aspects of the rule with respect to credit, operational risk, and market risk, and we're working through the substance of that now.
So do you think the consequences of the merger delays could significantly harm both kind of acquiring institutions and the targets, which could cause greater operational risk, I guess you could say, whether it's increased costs or even reputational kind of concerns? So do you think that with kind of this prolonged uncertainty, what effect do you think it's having right now?
Well, most mergers that we review at the Federal Reserve, the median merger application approval time is in under 2 months. So most mergers go through quite smoothly and easily. We do have much more complex cases, often involving larger institutions, where either we need to gather more information or there are difficulties in the application itself that have to be worked through, and we've got to meet the congressional factors for approval or disapproval. So again, most mergers, pretty straightforward. Some mergers, much more complicated.
So if there is something discovered, how do you guys typically handle do you circle back then and readdress these concerns, or how is that initially kind of addressed, and ultimately with the idea of maybe there's an opportunity to kind of make a change to the initial application?
Yes, Congressman, there's a lot of conversation back and forth. If the application initially presents issues, those can sometimes be addressed through the process. If there's information lacking, those can sometimes be addressed through the process. And at the end of the day, we need to meet the congressional 5 objectives that are laid out for us.
Very good. Thank you. I yield back, Chairman.
Gentleman yields back. We'll now recognize the gentleman from New York, Mr. Garbarino, for 5 minutes.
Thank you, Mr. Chairman. Thank you, the witnesses, for being here today. Vice Chair Barr, I'd like to follow up on a question that Representative Timmons asked you about the interaction between the long-term debt and the Basel III endgame proposals. To be direct, do you plan to finalize your Basel proposal before you finalize the long-term debt proposal?
We haven't made any procedural decisions. As I indicated earlier, we're really focused on the substance now. We got a lot of substantive comments on both the Basel III endgame and long-term debt. We're working our way through those. We are looking at the interaction across all of our rulemakings, and we'll make a decision on process after we make sure we've landed properly on substance.
All right. Given how interrelated these rules are, I think the long-term debt proposal should not be finalized before Basel III endgame, and Basel III needs to be reproposed with the new notice and comment period as required by the Administrative Procedure Act. Controller Su, I know the FDIC, which you sit as a board member, has looked at changes to passivity agreements. I'm concerned about the potential negative impacts these changes could have on access to bank capital, especially at the time of massive changes you're proposing on the Basel front. I'm also concerned about jeopardizing investor access to index funds, and retail investors are counting on those funds for retirements. Are you concerned about the potential negative impact on bank capital? Is this something that you have examined?
Thank you for the question. The issue recently came to the FDIC board for a vote, and there was a very live discussion of the issues. And my view is that those issues warrant careful discussion, deliberation, particularly across the 3 agencies, to the extent that all 3 agencies are often involved in ownership issues with banks.
So the negative, you all discussed the potential negative impact this would have on bank capital.
There are a range of views with regards to passivity, and I think that the liveliness of that discussion kind of highlighted how there's stuff we have to work through.
Okay. Chairman Grunberg, do you share those concerns as well?
Yeah, as Controller Su indicated, there was a lively discussion at our board meeting. No conclusion was reached. There are a variety of views. So this is something that I think the board is going to have to continue to engage on.
Back to Vice Chair Barr. I'd like to move on to the Fed's proposal to adjust the GSIB surcharge calculation. In 2015, when the Fed first issued the surcharge, the board acknowledged that a bank holding company's Method 2 score may be affected by economic growth that doesn't represent an increase in systemic risk. This fact, the board said it will periodically review the coefficients and make adjustments as appropriate, but to my knowledge, I don't think it has done so yet. Why release a proposal for public comment that omits this important discussion for consideration in your latest proposed rule?
Pardon me. We did receive comment on the proposal that went to this question about how to calculate the coefficient. We are looking at that comment along with the other comments we received on the proposal. The proposal also addressed narrowing the buckets of the GSIB surcharge and avoiding the problem of window dressing, as well as a number of technical adjustments to how we think about calculating the GSIB surcharge. We're taking all that comment on board. We're in the process of thinking through that now.
So before you released the proposal for public comment, you all discussed the coefficients and whether adjustments would be appropriate?
Sorry, before we released the proposal?
I'm just wondering, if this was all discussed before you opened it up for additional comment.
I don't think it would be appropriate to talk about internal conversations at the Federal Reserve. I'm certainly aware of the issue.
Okay, I appreciate that. I'm going to run out of time, so I'm just going to make a statement here. I'd like to follow up with Chairman Grunberg, and I'm going to issue a more detailed question. Hope you'll respond to it on what appears to be the FDIC's hostile aggression towards banks who partner with fintechs. I've heard from several banks, and what they've shared with me and what we're witnessing is an overly adversarial regulatory environment that is using enforcement action to discourage banks from partnering with fintechs. I will say that I find this troubling, as I'm sure a lot of my colleagues do, as the FDIC's posture will impact the development of what could be innovative products and services that benefit consumers and businesses, especially in New York and around the country. So I have a more detailed question that I hope to get a response from you on. But with that, Chairman, I yield back.
Gentleman yields back. The gentlelady from California, Mrs. Kim, is recognized for 5 minutes.
Thank you, Mr. Chairman. I know it's been covered by both sides of the aisle, but I want to register my serious concerns with the FDIC's cultural, discriminatory, and moral issues laid out in the Cleary report. And Mr. Grunberg, having heard several of my colleagues already address this and taking that into consideration, I would like to ask you to reconsider and gracefully maybe resign to give the FDIC new respective leadership to enact much-needed internal reforms. You don't need to respond to that, but I want you to reconsider that seriously. According to Chamber of Commerce letter from February, signed by one of the Chamber of Commerce in my city, my district, Yorba Linda, one of their surveys found that 68% of business owners believe that an increase in bank capital requirement would be damaging to their businesses. And given the concerns that businesses have with the bank capital increase, I was bothered when I read the May 1st Bloomberg article that made a number of claims of the flawed Basel III endgame proposal. One of the claims is that key officials decided to adjust the original proposal rather than start over. Another claim says that you are planning to be done as soon as August. So, Mr. Barr, given the Fed statement to Bloomberg refuting claims, would it be fair to assume that it was not someone at the Fed leaking it to the reporter?
I have no idea why the reporter wrote that. We issued our statement to make it clear that we have made no decisions about procedure. We're very focused on the substance and making sure we get the substance.
Let me ask you, Mr. Su, do you have any reason to believe it was someone at the OCC leaking the info?
No.
What about you, Mr. Grunberg? Are you aware of who was the source of the claims made in the article? It seems to me that whoever was leaking this information was trying to put pressure on other banking agencies. Is that a fair read?
Can't speak to the motivations, but I'm not aware of who was the source of the information.
Mr. Grunberg, the Fed is open and actively considering a full reproposal of the Basel Endgame proposal. Just last month, Chair Powell testified right here in our committee that they are aware of the potential for significant negative economic impact. The FTC, however, is reluctant to consider a reproposal and is pushing for it to be finalized. Do you think a reproposal is appropriate? And where do you stand on the benefits of a reproposal?
I think as Vice Chair Barr indicated, the three agencies right now are focused on trying to reach agreement on the substance of a rulemaking, and the decision on process going forward, I think we'll have to decide after we reach closure on the substance. So I think it's candidly an open question at this point.
Well, I want to switch to another topic here. What is the average time for issuing reports of examination following the date of the exit meeting? And how does this differ for those banks that are active in fintech space? Question to you, Mr. Grunberg.
I'd be happy to get back to you on that question, Congresswoman. I just want to check on the particular record to give you accurate information. Happy to do that.
I'm concerned by the disproportionate enforcement actions on fintechs and about what that can do to, give the customers opinions, options, and access to innovation. So I would urge regulatory parity for innovators. Mr. Barr, in your testimony, you mentioned that the Fed continues to work to improve the discount window tool. So can you give us some thoughts about how you are thinking about improving it?
Thank you very much for the question. Liquidity provision by the Federal Reserve has been an absolute bedrock for the financial system since the founding of the Federal Reserve. It did provide the underpinning for the Bank Term Funding Program and disco window borrowing last spring. But what we have heard from a number of banks is that there are procedural issues in their working with the discount window that could be improved. We're going to get more systematic impact from banks about those issues. One of the areas that, for example, we're working on is banks said it would be good to have an online portal. So we've started having an online portal to engage with the banks.
We had this conversation when you came before
about
our committee before too, right? So I would ask you to look into the stigma that was associated with the use of the discount window and its limited operations with institutions working on the East Pacific time zone, like where I'm from. Thank you, and my time's up. Thank you.
The gentleman from Nebraska, Mr. Flood, is recognized for 5 minutes.
Thank you, Mr. Chairman. Acting Comptroller Sue, you've spoken a few times in the last year about the separation of banking and commerce. From an activities perspective, can you expound on where that line is? Specifically, I want to know from you, where do payment activities fall on the banking and commerce spectrum?
Sure. So I think it's one way to think about it is banking consists of 3 services that are bundled together: facilitating payments, making loans, and taking deposits. So banks essentially, when banks are chartered, those are 3 activities that are bundled within the bank. When payments becomes unbundled from that on its own, that is commerce. That's not banking. What is happening sometimes is that those payment activities that get unbundled are sometimes being rebundled outside of the bank perimeter, and that, to me, starts to approximate banking outside of the bank regulatory perimeter, and it warrants monitoring.
Can you give me an example of rebundled?
Sure. So a payments company may start off providing payment services that are very narrowly defined as payment services, and then over time it would say, we can hold your cash as if it's a deposit and provide it with yield, and then we can also offer a loan. And that rebundling of services looks awfully similar to banking.
Thank you very much. Let me pivot quickly to bank fintech partnerships. I'm going to direct these questions to Chairman Gruenberg. I've stated in this committee previously that I feel bank fintech partnerships are important. I represent a rural state. We have mostly all community banks, very few regionals, very few, no GSIBs. I mean, there's connections there. But I worry about these bank fintech partnerships not being available to community banks and only the largest banks in the nation. I understand that sometimes a partnership with a fintech firm can introduce new risks, and I appreciate that there needs to be some framework for oversight of that. However, I've heard that in some cases, examiners are interpreting the new interagency guidance on this topic as more of a one-size-fits-all checklist. So here's the question, Mr. Chairman. The broad application of regulations under the third-party risk guidance and novel activities program has raised some concerns among stakeholders that regulators might be pushing to reduce or even dissolve existing bank fintech partnerships in favor of some more traditional banking operations. Is this a misinterpretation of the FDIC's intentions? If it is, would you please clarify what your intentions are and whether or not your agencies support banks partnering with financially sound and compliant technology companies, financial technology companies?
Thank you, Congressman. Candidly, I think it is a misinterpretation. As I indicated in response to a previous question, most banks manage third-party relationships, including third-party relationships with fintechs, in an appropriate way. They have risk management responsibilities if that third party is undertaking services provided by the bank, as well as consumer protection obligations. Most banks manage those well, and we're supportive of them. There are a few instances in which some banks have overreached, quite frankly, and gotten themselves into some difficulty, as you indicate, and then it becomes a matter of supervisory attention. But as a general matter, we're supportive of those relationships as long as they are managed appropriately and take into account the guidance that you referenced.
Thank you. Chairman Gruenberg, on June 6, 2023, the Federal Reserve, the FDIC, and the OCC issued final guidance regarding risk management expectations for banks partnering with fintechs. While prior third-party risk management guidance included supplemental materials published close to the finalization date, there was a delay in issuing an aid specifically tailored to aid the community banks in complying with this June 2023 guidance. Can you explain the reasons for that delay?
Not offhand, Congressman, be glad to get back to you in regard to that.
Thank you very much. With that, I yield back.
Gentleman yields back. I'd like to thank the panel for their testimony. I think there have been some notable calls, Mr. Grunberg, for you to reappear before the committee for my Democrat colleagues. I'll consult with the minority party on the committee about that. And I want to thank all of you for your testimony today. These are important positions. The focus shouldn't just be on cleaning up mismanagement, but it should be about the safety and soundness of our financial institution. I'm glad that is of bipartisan concern. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair. The questions will be forwarded to the witnesses for response. I ask our witnesses to respond no later than June 15th. And without objection, committee is adjourned.